Now we'll go to YouTube and see. You can see your screen here in a while. You can see that your screen has started to share. Now we'll click on this go live button and our live session has started. And to end the session, we'll click on this end stream and we'll click on this end button. So that's it about sharing your screen live on YouTube. See you in the next video.
We're able to track, as you said, where all this money is being spent and which companies are getting it. Employees can benefit greatly because they will have access to that.
Yeah. Thank you. I'm out of time here. I appreciate it. Mr. Chairman, thank you.
Thank you, Senator Gaines. Senator Warren, I believe, is here.
Well, thank you, Madam Chair. And let me just begin by saying I believe Americans are far more sophisticated, informed, and capable than people in D.C. give them credit for. When I called for this hearing last month, I wanted this to be a fact-finding commission. We have speculation, we have headlines and figure pointing, but we don't have the facts. We need facts, not just the salacious bits or nasty comments on Reddit. And look, there's plenty of that. We need the facts today. Now, some on the left are already putting new restrictions or things to protect these so-called uninformed retail investors who are their eyes on the difference between those I think if we've learned anything from the past few weeks, it's that these average everyday investors are pretty darn sophisticated. There is wisdom to the crowd. So let's zoom out on that idea just for a moment. The Gamestop story represents a larger truth. A fundamental change is happening. Like never before, everyday investors can communicate, access more information, and work collectively to move markets all in real time. Technology is fueling this revolution. Congress cannot put technology back in the markets. GameStop is a culmination of years of pent-up frustration. That frustration is now paired with faster, cheaper, and better technology. Consider for a moment that for every story of someone being able to pay off their student debt from the GameStop trade, or conversely, every story of somebody who lost money. There were stories of those who said they were investing in protest. In protest. They would gladly risk losing money just to prove a point. And now, while no one should ever risk investing money that they cannot afford to lose, let's tell the truth of why someone would do something like that. The sad truth is the K-shaped economy is nothing new in our capital markets because the structural core of our regulations literally enshrined in equity. Policies like the credit investor definition will legally pick winners and losers. If you're wealthy, you're good to go. And if you're not, you're too dumb to be trusted with your own money. So a privileged few get to invest alongside Ivy League endowments, getting early access to private markets to the greatest returns of the last few generations. But not so fast with every average everyday investor. And as for government, you need to be protected. Protected from your own decisions, protected from your own money, protected for opportunities. So you're left with a savings account which pays no interest in it. You need more money than that. Well, we create a world where it's easier to go buy a lottery ticket than it is to invest in the next school.
Same access to equity shares in Robinhood itself as the white-collar employees who work there. Same goes for Reddit and Reddit users, by the way. Both contributed to its success. Why can't both share in its future success? So I'll conclude with a reminder for some of my colleagues who want to regulate more and more. In the 1980s, Massachusetts state regulators barred citizens from investing in what the Wall Street Journal called the latest in a cascade of stocks of high technology companies that occurred that year. What IPO was too risky in the eyes of the government? Apple. So instead of shutting the American public out through new regulations, new forms of taxation, or so-called protections, let's use this opportunity instead to side with them. So I'll begin where I started. Americans are far more sophisticated, informed, and capable than folks in D.C. give them credit for. And it's time our securities laws treat them that way. I look forward to the hearing, and I yield back.
Thank you so very much. I'm so pleased that you are cooperating today and you were eager to join with us when we call for this committee. So I want to welcome today's distinguished witnesses to the committee. Mr. Vlad Tenev is the Chief Executive Officer of ROBINHOOD Markets Incorporated, a company with a trading act that after increased trading activity in Gamestop and certain other stocks, restricted trading of those stocks for a period of time. Mr. Kenneth C. Griffin is the Chief Executive Officer of Citadel, LLC, a fund which is one of Robinhood's main customers and sources of revenue, which also provided financial support to Melvin Capital Management LP when Melvin faced significant losses over GameStop and other trades. Gabriel Parker is the Chief Executive Officer of Melvin Capital Management LP, which held a significant short position in GameStop and other stocks and experienced significant losses due to its positions. Steve Huffman is the Chief Executive Officer, co-founder of Reddit, a social media platform which is home to the subreddit Wall Street Bets, where retail investors discuss trading and where a large number of members discuss the purchase of GameStop and other stocks which experience volatility. Mr. Keith Gill is a retail investor who posted on Reddit and YouTube regarding investing in GameStop and other stocks. Jennifer Gall is a director of financial regulation studies at the Cato Institute. Without objection, your written statements will be made part of the record. Each of you will have 5 minutes to summarize testimony.
Chairman here. It was I believe that there are only 3 minutes of Democratic opening statements with the idea that the subcommittee chair on the Democratic side would be called as well. That's what I was told by your staff.
Well, thank you very much. If that is the order that has been organized, I will cease my introductions and I will call on you, Mr. Sherman, to please go ahead and make an opening statement. Thank you.
Thank you so much. Back in the day, the law school professor would create an exam where he'd weave together a story that would exemplify each of the issues in that area of the law. But never did the professor do it as good a job as the GameStop saga, which identifies most of the issues facing our capital markets. Short selling. Should there be limits or required additional disclosures? What do we do with market participants, whether they be on Reddit or on Wall Street, who are shorting a stock or buying a stock for the purpose of influencing its price? What is this payment for order flow model, and what does it mean when some price enhanced best execution, and are all traders being treated fairly, and is payment for order flow free to the consumer? We need to look at the plumbing where it takes 2 days to settle a transaction, but also why is it the broker's capital rather than the customer's capital that is posted during that 2-day period? And finally, we need to look at the gamification and glorification of high frequency trading. I thank the chairwoman for the time, and I hope that in the months to come, we have several hearings to explore these issues, and that we're able to pass legislation this year to deal with each of them, and I yield back.
Thank you. The chair now recognizes the chairman of the Subcommittee of Oversight and Investigations, the gentleman from Texas, Mr. Green, for 1 minute.
Thank you very much, Madam Chair. I greatly appreciate the opportunity to express some concerns that I have. It is a fact that Citadel Securities has paid over $100 million in penalties. And my concern is this. It deals with whether we can allow a market maker's profits from misleading clients and improperly trading ahead of clients to become something as simple as the cost of doing business The risk of punishments for violations must always exceed the rewards to deter the risk. I'm concerned, and my hope is that we'll get some additional intelligence on how these punishments have impacted the rewards that have been received. I yield back.
Thank you very much. And I will go back to the introduction of our witnesses. I left off with Jennifer Sklupp, Director of Financial Regulation Studies at the Cato Institute. Without objection, your written statements will be made part of the record. Each of you will have 5 minutes to summarize your testimony. You should be able to see a timer on your screen that will indicate how much time you have left, and a chime will go off at the end of your time. I would ask you to be mindful of the timer and quickly wrap up your testimony if you hear the chime. Now, before we begin with your oral testimonies, I would like to swear in the witnesses. I will call each of your names individually to respond. Would you please raise your hands? Do you solemnly swear to affirm that the testimony you will give before this committee in the matters now under consideration will be the truth, the whole truth, and nothing but the truth, so help you God? Mr. Tenet?
I do.
Mr. Griffin?
I do.
Mr. Plotkin? Mr. Plotkin?
I was muted. I apologize. I do.
Thank you. Mr. Huffman?
I do.
Mr. Gill?
I do.
Ms. Scott?
I do.
Thank you very much. Let the record show that all of the witnesses answered in the affirmative. We will now begin with their oral testimonies. Mr. Tenet, you are recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, members of the committee. My name is Vlad Tenev, and I'm the Chief Executive Officer and co-founder of Robinhood. Thank you for the invitation to speak about Robinhood and the millions of people we serve. Almost 8 years ago, Beju Bhatt and I founded Robinhood. We believed then, as we do now, that the financial system should be built to work for everyone, not just a select few. We dreamed of making investing more accessible, especially for people without a lot of money. The stock market is a powerful wealth creator, but only half of U.S. households participate in it.
Mr. Staff, I would like you to use your limited time to talk directly to what happened January 28th and your involvement in it.
Certainly.
Madam Chair, the witness has the opportunity to give their own testimony.
Excuse me, you are
Here's your
not
time for your questioning.
You are not recognized, Mr. Please go right ahead and speak directly to the question.
McHenry.
Mr. McHenry, yes, of course.
We created Robinhood to economically empower all Americans by opening financial markets to them. I was born in Bulgaria, a country with a financial system that was on the verge of collapse. At the age of 5, I immigrated with my family to America in search of a better life. I have benefited from all America has to offer, and Robinhood's mission to democratize finance for all has a very special significance for me. Robinhood's platform allows people from all backgrounds to invest with no account minimums and 0 commissions. Contrary to some very misleading and highly uninformed reports, we see evidence that most of our customers are investing for the long term, with features like fractional shares, dividend reinvestment, recurring investments. Our customers can start with small amounts and grow their investments in blue chip stocks and ETFs over time. We've always recognized the responsibility that comes with helping people invest. We'll continue to enhance our educational platform to help customers no matter where they are in their financial journey. Hundreds of free educational resources are available to everyone on our Learn website right now. While markets fluctuate, this tells me our business model is working for everyday Americans. The total value of our customers' assets on Robinhood exceeds the net amount of money they have deposited with us by over $35 billion. This tells me our business model is working for everyday Americans, the Robinhood community. Many people say that Robinhood has helped them to pay car loans, reduce student loan debt, meet daily bills, save for the future, and we're proud to serve them. You've invited me today to discuss the events of last month, and I welcome this opportunity. In late January, many brokerage firms saw a massive increase in trading activity in a handful of stocks. Prices were moving dramatically day to day, even hour to hour. One specific day, January 28th, proved to be a completely unprecedented event. The spike in trading activity and volatility meant that Robinhood Securities, our clearing broker, had to hold the line and post additional firm capital as collateral to support our clearinghouse deposit demands. To put it in perspective, on January 28th, our daily deposit requirement was 10 times more than on January 25th. As a result, Robinhood Securities, along with many other firms, imposed temporary trading restrictions on certain securities. We began allowing limited buys of these securities the following day, and we have since lifted the restrictions entirely. There are 2 points I want to make clear about these temporary restrictions. First, Robinhood Securities put the restrictions in place in an effort to meet increased regulatory deposit requirements, not to help hedge funds. We don't answer to hedge funds. We serve the millions of small investors who use our platform every day to invest. Second, Robinhood immediately secured additional funds. Altogether, through capital raising and other measures, we've increased our liquidity by more than $3 billion to cushion ourselves against increased collateral requirements and related market stress in the future. Despite the unprecedented market conditions in January, at the end of the day, what happened is unacceptable to us. To our customers, I'm sorry and I apologize. Please know that we are doing everything we can to make sure this won't happen again. And I want to highlight one more thing. The existing 2-day period to settle trades exposes investors and the industry to unnecessary risk. There is no reason why the greatest financial system in the world cannot settle trades in real time. I believe we can and should act now to deploy our intellectual capital and our engineering resources to move to real-time settlement. Together, we can solve this. Before I close, I want to sincerely thank the millions of customers who continue to use Robinhood to access the markets every day. We are grateful and committed to you. Members of the committee, I appreciate the opportunity to answer your questions.
Mr. Griffin, you are now recognized for 5 minutes to present your oral testimony.
Chairman Waters, Ranking Member McHenry, distinguished members of the committee, thank you for the opportunity to testify today on the recent market events. The U.S. capital markets are the envy of the world. Our nation's ability to allocate capital to its best and highest use creates jobs, drives innovation, and fuels our economy. America's retail investors play an important role in our capital markets. According to Gallup, about 55% of Americans own stock right now. Citadel Securities, as the largest market maker in the U.S. equities market, executes more trades on behalf of retail investors than any other firm. As I will discuss shortly, Citadel Securities played an important role in meeting the needs of retail investors during the week of January 24th. Before doing so, I want to be perfectly clear. We had no role in Robinhood's decision to limit trading in Gamestop or any of the other meme stocks. I first learned of Robinhood's trading restrictions only after they were publicly announced. All of us at Citadel Securities are committed to the healthy functioning of the U.S. equities markets. Now, I first participated in the financial markets as a retail investor. In the late 1980s, while attending college, I traded stocks and options from my dorm room. My passion for investing led to my founding of Citadel in 1990. Today, Citadel is one of the world's leading alternative investment managers. Our capital partners include pension plans, colleges, hospitals, foundations, and research institutions. In 2002, my partners and I founded Citadel Securities. Today, Citadel Securities is one of the world's preeminent market makers. We have been a leader in using technology to transform our markets, particularly for retail investors. Citadel Securities invests hundreds of millions of dollars each year to serve the needs of our customers. In the last week of January, the importance of this investment was on full display. During the period of frenzied retail equities trading, Citadel Securities was able to provide continuous liquidity every minute of every trading day. When others were unable or unwilling to handle the heavy volumes, Citadel Securities was there. On Wednesday, January 27th, we executed 7.4 billion shares on behalf of retail investors. To put this into perspective, on that day, Citadel Securities executed more shares for retail investors than the entire average daily volume of the entire U.S. equities market in 2019. The magnitude of the orders routed to Citadel Securities reflects the confidence of the retail brokerage community in our firm's ability to deliver in all market conditions and underscores the critical importance of our resilient and stable systems. I could not be more proud of our team at Citadel Securities. My colleagues who were committed to ensuring that the interest of America's retail investors were served during this extraordinary period. Once again, I appreciate the opportunity to appear today, and I look forward to answering your questions.
Thank you, Mr. Griffin. Mr. Plotkin, you're now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and members of the committee, I would like to thank you for this opportunity to share Melvin Capital's perspective on the recent trading activity in Gamestop. I am the founder and chief investment officer of Melvin Capital. I am humbled by these unprecedented events. Many investors on all sides have experienced losses. I am here today to share my own personal experience and to be helpful in this conversation. I understand that part of the focus of this hearing is the decision of stock trading platforms to limit trading in GameStop. I want to make clear at the outset that Melvin Capital played absolutely no role in those trading platform decisions. In fact, Melvin closed out all of its positions in GameStop days before the platforms put those limitations in place. Like you, we learned about those limits from news reports. I also want to make clear at the outset that contrary to many reports, Melvin Capital was not bailed out in the midst of these events. Citadel proactively reached out to become a new investor, similar to the investments others make in our fund. It was an opportunity for Citadel to buy low and earn returns for its investors if and when our fund's value went up. To be sure, Melvin was managing through a difficult time, but we always had margin excess and we were not seeking a cash infusion. I'm here testifying today far removed from my background. I grew up in a middle-class family in Portland, Maine. I went to a public high school. I studied hard and got into a good college. Upon graduation, I did not have a job. Today, I'm married with 4 children, and my time is spent with my family and on Melvin Capital, which I founded 6 years ago. I named Melvin after my grandfather, who ran a convenience store. I wanted the firm to represent his values, integrity, hard work, taking care of customers and employees, and commitment to excellence. Melvin Capital manages a hedge fund. Investors such as academic institutions, medical research and other charitable foundations, pension funds, retirees, and others invest with us. We have 36 employees and hundreds of investors, and I feel a personal duty to all of them. Melvin specializes in the consumer and technology sector, including companies like GameStop, AutoZone, and Expedia. Most of our investments are long. In other words, we buy stock in companies that create jobs, grow the economy, and develop new products for consumers. We do this after extensive fundamental research, sometimes literally for years. When our research convinces us that a company will grow relative to expectations, we make a long-term investment. When our research suggests a company will not live up to expectations and its stock price is overvalued, we might short a stock. Like with our long positions, our practice is to short a stock for the long term after extensive research. We also short stocks because when the markets go down, we have a duty to protect our investors' capital. There are laws governing shorting stock, and of course, we always follow them. In addition, it's very important to understand that absolutely none of Melvin's short positions are part of any effort to artificially depress or manipulate downward the price of a stock. Nothing about our short position prevents a company from achieving its objectives. It is just Melvin's view about whether it will. Specific to GameStop, we had a research-supported view well before the recent events. In fact, we had been short GameStop since Melvin's inception 6 years earlier, because we believed and still believe that its business model, selling new and used video games in physical stores, is being overtaken by digital downloads through the internet. And that trend only accelerated in 2020 when, because of the pandemic, people were downloading video games at home. As a result, the gaming industry had its best year ever, but GameStop had significant losses. In January 2021, a group on Reddit began to make posts about Melvin's specific investments. They took information contained in our SEC filings and encouraged others to trade in the opposite direction. Many of these posts were laced with anti-Semitic slurs directed at me and others. The post said things like, "It's very clear we need a second Holocaust. The Jews can't keep getting away with this." Others sent similarly profane and racist text messages to me. In the frenzy during January, GameStop stock rose from $17 to a peak of $483. I do not think anyone would claim that the price had any relationship to the intrinsic value of the business. The unfortunate part of this episode is that ordinary investors who were convinced by a misleading frenzy to buy GameStop at $100, $200, or even $483 have now lost significant amounts. When this frenzy began, Melvin started closing out its position in GameStop at a loss. Not because our investment thesis had changed, but because something unprecedented was happening. We also reduced many other Melvin positions at significant losses, both long and short, that were the subject of similar posts. I'm personally humbled by what happened in January. Investors in Melvin suffered significant losses. It is now our job to earn it back. And while I do not think that anyone could have anticipated these events, I've learned much from them, and I'm taking steps to protect our investors from anything like this happening in the future. I look forward to answering your questions.
Thank you, Mr. Plotkin. Mr. Huffman, you are now recognized for 5 minutes to present your oral testimony.
Thank you. Madam Chairwoman, Mr. Ranking Member, honorable members of the committee, my name is Steve Huffman. I am the co-founder and CEO of Reddit, and I'm pleased to talk with you today about how Reddit works and what we have seen on our site in the past few weeks. Reddit's mission is to bring community and belonging to everyone in the world. What started in 2005 as a single community has since evolved into a vast network of many thousands of communities. They range from standard topics like news, sports, politics, to internet culture, to support. For example, our unemployment community has become a source of support for hundreds of thousands of Americans who have turned to Reddit after losing their jobs during the pandemic. Our communities are created and run by our users. Because of this, we describe Reddit as the most human place on the internet. Though we are small compared to the largest platforms, our communities provide an online home for millions of people every day. I'd like to share a bit about how content moderation on Reddit works. Reddit's moderation system starts with our content policy, the platform-wide rules which all communities must follow. Among other things, these rules prohibit hate, harassment, bullying, and illegal activity on Reddit, and they are enforced by Reddit's anti-evil team, which is composed of engineers, data scientists, and other specialists. This team also ensures the integrity of the site, and we have continuously honed our methods to stay ahead of bad actors to protect Reddit from manipulation, spam, and other threats. This team searched high and low for the specific comment mentioned in the previous testimony, or anything like it. The closest we could find was a single comment that received no votes and was deleted within 5 minutes. Such speech is not tolerated on Reddit, and we will of course investigate any further claims of this nature. Centralized moderation is common, but Reddit additionally uses a governance structure akin to a federal democracy, where the aforementioned policies and teams represent the federal government and the communities themselves represent states. All communities, or subreddits, are created by users that we call moderators. They set the community's rules, which may be as strict as they like as long as they are not in conflict with the platform-wide policies, and they have a variety of tools of enforcing these rules independently. Moderators are not paid employees, but rather users who are passionate about their communities. They have the context and judgment to make decisions no algorithm could. The members of each community contribute both the content itself and the ranking of it by voting up or down on any post or comment. Unlike other platforms where submission has a built-in audience through the author's follower count, every piece of content on Reddit, no matter how famous the author, starts at 0 and has to earn its visibility. Through their votes, the community itself enforces not just the explicit rules of their community, but also the unwritten rules that define their culture. This layered approach has helped our users create the most authentic communities online. The specific community we'd like to talk about today is Wall Street Bets. It's important to understand that Wall Street Bets is one of many finance and investing related communities on Reddit. This particular community specializes in higher risk, higher reward investments than what you might find in other more conservative financial communities on Reddit, with such names as personal finance, investing, and financial independence. I will stress that Wall Street Bets is first and foremost a real community. The self-deprecating jokes, the memes, the crass at times language all reflect this. And if you spend any time on Wall Street Bets, you'll find a significant depth to this community exhibited by the affection its members show one another. They are just as quick to support a fellow member after a big loss as they are to celebrate after a big gain. A few weeks ago, we saw the power of community in general and of this community in particular when the traders of Wall Street Bets banded together at first to seize an investment opportunity not usually accessible to retail investors, but later more broadly to defend all retail investors against the criticism of the financial establishment. With the increase in attention, Wall Street Bets unsurprisingly faced a surge in traffic and new users. At Reddit, our first duty in these situations is to our communities, and our role in this moment was to keep Wall Street Bets online. Working around the clock, we scaled our infrastructure, made technology changes to help this community withstand the onslaught of traffic, and we acted as diplomats to help resolve conflict within Wall Street Bets leadership. We have since analyzed the activity in Wall Street Bets to determine whether bots, foreign agents, or other bad actors played a significant role. They have not. In every metric we checked, the activity in Wall Street Bets was well within normal parameters, and its moderation tools were working as expected. We will, of course, cooperate with valid legal requests from federal and state regulators. That said, we do believe that this community was well within the bounds of our own policies. To conclude, I would like to reiterate why it is important to protect online communities like Wall Street Bets. Wall Street Bets may look sophomoric or chaotic from the outside, but the fact that we're here today means they've managed to raise important issues about fairness and opportunity in our financial system. I'm proud they use Reddit to do so. Thank you, and I look forward to your questions.
Thank you very much, Mr. Huffman. Mr. Gill, you are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters, Ranking Member McHenry, members of the committee. I'm happy to discuss with the committee my purchases of Gamestop shares and my discussions of their fair value on social media. It is true that my investment in that company multiplied in value many times. For that, I feel enormously fortunate. I also believe the current price of the shares demonstrates that I've been right about the company. A few things I am not. I am not a cat. I am not an institutional investor. I am not a hedge fund. I do not have clients.
That's awesome.
And I do not provide personalized investment advice for fees or commissions.
Awesome.
I'm just an individual whose investment in GameStop and posts on social media were based upon my own research and analysis. I grew up in Brockton, Massachusetts. My family was not wealthy. My father was a truck driver and my mom a registered nurse. I was one of 3 kids and the first in my family to earn a 4-year college degree when I graduated from Stonehill College in 2009. That was not a good time to be looking for a job. From 2010 to 2017, I worked at a few startup companies, but there were significant periods when I was unemployed. I took an interest in the stock market, and even though I had very little money, I used those times to educate myself and learn more about investing. In 2019, after nearly 2 years unemployed, I accepted a marketing and financial education job at MassMutual. My wife Caroline and I were thrilled that I had an income and benefits. My job was to help develop financial education classes that advisors could present to prospective clients. I was not a stockbroker or a financial advisor. I did not talk to clients, and I did not recommend stocks for them to buy. Before and after I joined MassMutual, I studied and followed stocks. One of those was GameStop. In early June of 2019, the price of GameStop stock declined below what I thought was its fair value. I invested in GameStop in 2019 and 2020 because, as I studied the company, I became more and more confident in my analysis. 2 important factors, based entirely on publicly available information, gave me confidence that GameStop was undervalued. First, the market was underestimating the prospects of GameStop's legacy business and overestimating the likelihood of bankruptcy. I grew up playing video games and shopping at GameStop, and I plan to continue shopping there. GameStop stores still provide real value to consumers and reliable revenue for GameStop. Second, I believe that GameStop has the potential to reinvent itself as the ultimate destination for gamers within the rapidly growing $200 billion gaming industry. GameStop has a unique opportunity to pivot toward a technology-driven business. By embracing the digital economy, GameStop may be able to find new revenue streams that vastly exceed the value of its business. I am hardly the only person who has advocated these points. When I wrote and spoke about GameStop on social media with other individual investors, our conversations were no different from people in a bar or on a golf course or at home talking or arguing about a stock. Hedge funds and other Wall Street firms have teams of analysts working together to compile research and analyze shares of companies. Individual investors do not have those resources. Social media platforms like Reddit, YouTube, and Twitter are leveling the playing field. The idea that I use social media to promote GameStop stock to unwitting investors and influence the market is preposterous. My post did not cause the movement of billions of dollars into GameStop shares. It is tragic that some people lost money, and my heart goes out to them. But what happened in January just demonstrates again that investing in public securities is extremely risky. As I said earlier, I consider myself and my family fortunate with our investment. When the stock price broke $20 in December, I knew my investment was a success. I was so happy to visit my family in Brockton for the holidays. The money will go such a long way for us. We had an incredibly difficult 2020. Most difficult was the tragic and unexpected loss of my sister Sarah in June. I am grateful to be in a position to give back to and support my family. As for what happened in January, others will have to explain it. It's alarming how little we know about the inner workings of the market. And I am thankful that this committee is examining what happened. I also want to say that I support retail investors' right to invest in what they want, when they want. I support the right of individuals to send a message based on how they invest. As for me, I like the stock. I'm as bullish as I've ever been on a potential turnaround for GameStop, and I remain invested in the company. Thank you. Cheers, everyone.
Thank you, Mr. Gill. Ms. Schrupp, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and distinguished members of the Committee on Financial Services. My name is Jennifer Schulp, and I am the Director of Financial Regulation Studies at the Cato Institute's Center for Monetary and Financial Alternatives. Thank you for the opportunity to take part in today's hearing. Before addressing the GameStop phenomenon specifically, I'd like to talk about the participation of retail or individual investors in our public equities markets. Retail participation has ebbed and flowed over the years, but the recent upward trend accelerated sharply during the pandemic. Most point to zero commission trading, but several other factors also likely attracted retail investors, including fractional share trading, low account minimums, and easy app-based platforms. More time at home during the pandemic probably even played a role. Retail participation in our equities markets is important. The fact that retail investors behave differently from institutional ones and differently from each other can be particularly valuable in times of market stress. In fact, individual investors may have helped stabilize the market in March 2020. Importantly, investing in the stock market also provides a path to wealth for individual investors. But stock ownership traditionally has been skewed towards the already wealthy, and it is highly correlated with race, education, and age. Retail investors making up this new surge are different. Recent research by the FINRA Investor Education Foundation and NORC at the University of Chicago found that investors who opened accounts for the first time in 2020 were younger, had lower incomes, and were more racially diverse. These new investors also held lower account balances. This may portend, as one of the researchers noted, quote, a shift towards more equitable investment participation. These new opportunities for individuals to grow their wealth should be welcomed and expanded, not restricted. Now I'll turn to GameStop. At the outset, I will note that it is difficult to analyze the impact of the trading in GameStop and other stocks because many facts are unknown. But some things seem clear. Importantly, the temporary volatility in these stocks did not present a systemic risk to market function. As the Treasury Department recognized, the market's, quote, core infrastructure was resilient during high volatility and heavy trading volume. This is not surprising. Despite the huge trading volume and rapid increase in value, only a small part of the market was affected, and spillover effects on the wider market were mild and short-lived. The fact that GameStop traded temporarily, and perhaps still trades above fair estimates of the company's value, is not, by itself, a reason for concern. Stock prices move in and out of alignment all the time, and markets are no strangers to bubbles. If a company is valued by the market differently than a review of its fundamentals suggests, it might indicate that the analysis is missing relevant information about a company's prospects, or it might indicate that the company's stock price is due for a correction. The market's mechanisms, including the tool of short selling, generally work well to handle these circumstances. Stepping in to prevent trading where a stock price moves contrary to conventional wisdom could deprive the market of important information. The SEC, among a host of others, is reviewing the relevant trading and conducting a study of the events. The SEC will have access to far more information than has been made publicly available, and I believe it has the tools necessary to address any harmful misconduct that may have occurred. I cannot opine on whether any regulatory changes are warranted on this incomplete record. I tend to believe the answer will be no in light of the minimal impact on the market's function. But if regulators learn more, there may be areas identified for improvement. By no means, though, should these events lead to restrictions on retail investors' access to the markets. Thank you, and I welcome any questions that you may have.
Thank you, Ms. Sharp. I now recognize myself 5 minutes for questions. The market volatility surrounding GameStop and other securities has highlighted how many people feel that the cards are stacked against them, and that market participants, like our witnesses, hide the ball. Mr. Teneve, you explained that Robinhood restricted transactions in certain securities to meet demands coming from your clearinghouse, and yet on January 28th, you represented to the media that there was no liquidity problem. Isn't it true that being concerned about having enough capital to meet deposit requirements, isn't that a liquidity problem? Or could you just answer yes or no?
Chairwoman Waters, I appreciate the opportunity to address that.
It's yes or no?
We always felt comfortable with our liquidity and the additional capital that Robinhood raised.
Please answer yes or no.
We always felt comfortable with our liquidity.
I don't have time. I just need a yes or no answer.
I stand by my statement. The additional capital we raised wasn't to meet capital requirements or deposit requirements.
Gentlemen,
excuse me.
I'm reclaiming my time. This liquidity problem had real consequences for your customers, but I wonder if they were all that surprised. Between December 2019 and December 2020, Robinhood customers experienced monetary losses due to system outages. Customer accounts were reportedly compromised. The firm repeatedly failed to testify its best execution obligations, and it misled its customers regarding its revenue sources. It seems retail investors often get a bad deal at Robinhood. Mr. Teneve, also, while you testified today that, quote, Robinhood's customers benefit greatly from payment for order flow, quote unquote, in December 2020, the SEC charged Robinhood for not disclosing that it was getting paid to send customer trades to Citadel Securities and other market makers, and for not seeking the best terms for its customers' orders. Robinhood provided such inferior trade prices, it cost your customers over $34 million Is your testimony after Robinhood paid, is it your testimony after Robinhood paid the SEC $65 million to settle those charges that this conflict of interest is in your customer's best interest? Yes or no?
Chairwoman Waters, first let me say regulatory compliance is at the center of everything that we do. We've made mistakes in the past. I'm not claiming that.
Answer yes or no to that question.
So Citadel Securities is an important counterparty. Nobody's denying that. The reason that...
Gentlemen, can I answer yes or no? I'm reclaiming my time. Meanwhile, Mr. Griffin, Citadel's role in this event also raises significant questions for policymakers. Citadel Securities pays Robinhood tens of millions of dollars to process trades by Robinhood's customers. This relationship gives Citadel Enterprise key non-public information as to direction and volume of trades by retail investors. Your firm makes use of private exchanges called dark pools and other off-exchange trading to trade large sizes without moving the market against you. In fact, at some point last month, 50% of all trades occurred in dark pools or via OTC off-exchange trades. Your business strategy is designed intentionally to undermine market transparency and skim profits from companies and other investors. One problem, though, Mr. Griffin, is that we don't really know how central your firm has become to the capital markets. Mr. Griffin, does Citadel handle 47% of the U.S. listed retail volume? Please, yes or no.
Excuse me, Chairman Waters, what percentage? I couldn't hear that number.
47%.
So, Chairman Waters, to the best.
Yes or no?
So the odd, to the best of my knowledge, we handle in excess of roughly 40% of all retail volume.
Thank you very much. Reclaiming my time. Mr. Griffin, on January 27, did Citadel execute 7.4 billion shares for retail investors, which would be more trades than the average daily volume of the entire United States equities market in 2019? Yes or no?
Chairman Waters, that was my written and oral testimony.
Thank you very much. And with that, I now recognize the distinguished ranking member, Mr. McHenry, for 5 minutes for questions.
All right, thank you. Mr. Tenet, I'm going to come to you first. I just want to get to what happened on that day in January. So let's take a step back here. You get a call in the middle of the night, according to what I've heard you in interviews say. And based off that conversation with your compliance team, you decided to halt the buying of GameStop stock. People were furious. We'll get into the regulations and the settlement parts of that today. We will get to that. But this is what I think needs to be answered about your decision. Why did Robinhood restrict the buying but not the selling of GameStop? And why did folks get locked out on the buy side only?
Ranking Member McHenry, I appreciate the opportunity to address that. The reason that Robinhood, first of all, let me say Robinhood is always committed to providing access. It's in our name. It's in everything that we do. The decision to restrict GameStop and other securities was driven purely by deposit and collateral requirements imposed by our clearinghouses. So buying securities increases our collateral requirements. Selling does not. Moreover, preventing customers from selling is a very difficult and painful experience where customers are unable to access their money. So we don't want to impose that type of experience on our customers unless we have no other choice. And even though I recognize customers were very upset and disappointed that we had to do this, I imagine it would have been significantly worse if we prevented customers from selling.
Okay, so let me ask this question. Is payment for order flow legal?
Yes, payment for order flow is legal and regulated
and
in a common industry.
And is this disclosed to those users of your app?
Yes, payment for order flow is disclosed in multiple places. And moreover, payment for order flow enables commission-free trading. And that's why it's become the industry standard model, as other brokerages have replicated our model and started offering commission-free trading to their customers as well.
Okay, so to that, to this greater point of what happened that day and the model that you're using, let's be crystal clear. That decision you made to restrict the buying but not the selling of GameStop was based, was it based on pressure from anyone on the witness panel here today?
Not at all. Zero pressure from anyone. It was a collateral depository requirement decision made by our Robinhood Securities president.
All right, so let me get into this other question. Let me get into this question. You want to democratize finance. You want to open up Wall Street to retail investors. You say that Robinhood's mission is to democratize finance for all. So let's talk about that. So yes or no, can a Robinhood customer invest in Robinhood, the company?
Robinhood's currently a private company, so that's not possible, no.
And so you mean to tell me that the people that use your platform, that make you a successful company, and I would say directly contribute to your company's exponential growth and success, they don't get the same access to equity shares as a Robinhood employee or your institutional investors. Is that correct?
Currently, that is correct, yes.
All right, Ms. Schultz, let me pivot to you. Why is that? Why is it that everyday investors on the Robinhood app, people that I would argue contributed to its success, can't invest in Robinhood itself?
The SEC limits a lot of investment in private companies to those folks that are known as accredited investors. And to become an accredited investor, you have to have meet a wealth test of earning at least $200,000 a year, or having a net worth of over $1 million. The vast majority of people in this country don't meet that standard and are unable to invest in most private companies.
Okay, so let me just clear this. Mr. Tenev, I don't blame you for the restriction you put on your customers not being able to invest in equity. I'd like to have more opportunity to ask Mr. Gill his thoughts on this, but let me just say this. I don't fault you for the inequitable regulatory structure that DC has created, but I think we need to clear this up. Final thing, Madam Chair, I have for the record, I'd like to submit a letter from the DTCC, which is the clearing company, that was not on the panel today, and your staff has this letter.
Order.
All right, thank you all, and look forward to getting to the facts.
From other members, Ms. Maloney.
Thank you, Chairwoman Waters and Ranking Member McHenry for convening this hearing. I hope today's hearing sheds light on how our markets are working, or in many cases are not working, for smaller investors and ways we can fix that. The events of late January saw tremendous volatility and stock prices that were totally divorced from market fundamentals. The whole enterprise was viewed by some as a giant video game, trading stocks instead of properties and monopoly money. But it's not all fun and games, because people can lose their life savings, their hard-earned cash, and tragically, last summer we know of at least one suicide linked to potential trading losses. Beyond those possible losses, the actions of Robinhood and other trading platforms during the GameStop frenzy caused confusion, anger, and undermined investor confidence in the fundamental fairness of our capital markets. None of this is healthy for our markets or good for investors. What makes markets work fairly is when everyone knows the rules and that the rules remain consistent and predictable and are enforced. But because of Robinhood's actions, too many customers did not get that predictability. Many retail investors woke up on January 28th to find that they could no longer buy and sell stocks the same way they could the days prior, and they were being treated differently than other market participants who could still buy and sell those same stocks. So I don't blame them for thinking that things were stacked against the little guy. Mr. Tinev, you stated in your testimony that Robinhood restricted trading for certain securities, including Gamestop, in order to meet your financial requirements with your clearinghouse. But when I go to Robinhood's website and the blog post you initially released on January 28th, your financial requirements with your clearinghouse are not mentioned. You only mention market volatility. And when I review the Robinhood customer agreement, you don't include specifics on how and when you may decide to restrict trading, which you did. And you don't include any language or disclosures regarding your capital requirements. It only includes vague language that at any time and in its sole discretion, Robinhood can restrict trading. In other words, you seem to reserve the right to make up the rules as you go along. So I have two questions for you. First, do you think you owe your customers more disclosure and transparency than you gave them? And second, do you believe your lack of candor with your customers might have contributed to the wild speculation and confusion that resulted in the aftermath of your trading restrictions?
Congresswoman, I appreciate the question. So to answer the second question, look, I'm sorry for what happened. I apologize, and I'm not going to say that Robinhood did everything perfect and that we haven't made mistakes in the past, but what I commit to is making sure that we improve from this, we learn from it, and we don't make the same mistakes in the future. And Robinhood as an organization will learn from this and improve to make sure it doesn't happen again. And I'll make sure of that.
Well, I expect we will experience future events with increased volatility, and Robinhood's recent actions appeared arbitrary, which is why I don't blame customers for feeling treated unfairly. Your trading restrictions came out of the blue, and your communication was not clear. So my next question, Mr. Tinev, looking forward, what operational changes is Robinhood making to better respond to future market volatility, to improve transparency with your customers, and to ensure retail customers don't get the rug pulled out from under them at the last minute?
Thank you for that question, Congresswoman. We'll be committing to reviewing absolutely everything about this. The $3.4 billion that we raised, I think, goes a long way to cushioning the firm from future market volatility and other similar black swan events. And I believe that even throughout this process, we improved our risk management processes and strengthened them so that the experience customers had on Friday of that week was much improved from Thursday.
Thank you.
We'll continue to learn and improve upon this.
Ms. Wagner, you're recognized for
Thank you, Madam Chairwoman. I'd like to welcome our witnesses for testifying today to discuss the late January market volatility that took place, along with what I hope is a broader discussion on market functions and their effect on everyday investors. Since I was very first elected, I have advocated for America's Main Street investors and worked tirelessly to ensure that all Americans, especially those low and middle income savers, are given the investment choice, access, and affordability that they deserve. Retail investors are the strength of our stock market, and I have fought throughout my career for their best interests in the financial markets, and this hearing today is no different. The advances in financial technology that we've witnessed in the last decade have improved the way that Americans and our businesses perform financial activities. In just the past year, we have seen retail investors' market participation more than double. And I think this is great. I believe in the wisdom of the retail investor, and I will say I believe in the First Amendment too. This increase is attributed to Robinhood and other trading brokerages who are lowering account minimums, permitting fractional share trading, and implementing zero commission trading. It's critical that Congress focus on reducing barriers to market participation, which is rarely want to do, let me sadly say, and allowing Main Street Americans access to the financial instruments that can create long-term investment savings. All of these changes have given millions of Americans the ability to invest better for their families and their future. My hope is that the majority does not use this hearing as an excuse to once again add new federal regulatory burdens to an industry that is already heavily regulated and that will prevent people from participating in our capital markets. Letting existing regulations work is key, not burdening everyday investors with new and more costly barriers to entry. Mr. Tenet, it appears at the time your company did not have enough money to meet the collateral requirements for that level of trading by your customers. In your view, A, were collateral requirements from the DTCC unreasonably high? Was the amount of trading on your platform unforeseeable? Or was your company undercapitalized given its risk profile?
Thank you for the question, Congresswoman. So this event was a 5 Sigma event, which is a 1 in 3.5 million event. To put that in context, there have only been tens of thousands of stock market days in the history of the US stock market. So a 1 in 3.5 million event basically is unmodelable. That said, we can learn from it. And in this particular case, our risk management processes worked appropriately to keep us in compliance with all of our deposit requirements and collateral requirements.
Well, Mr. Tev, I realize that you are doing a full review of your practices and such. I encourage you to do that. And certainly communication with your investors is going to be key to that because you didn't communicate with them early on. Let me just say, as the ranking member on the Diversity and Inclusion Subcommittee, I am delighted to be speaking with our witness, Ms. Jennifer Schultz. Ranking Member McHenry and I have spent countless hours stressing the importance of having qualified women in finance. So I'm pleased to have you here today to lend your expertise. Ms. Schultz, we now know that it was the daily collateral demands set by the National Security Clearing Corporation that were the reason Robinhood had to temporarily restrict trading. Can you briefly explain the purpose of these capital requirements and their overall relationship to ensuring our markets function in an orderly manner? And did you see any broad failures of market function during these events, ma'am?
Sure, thank you. Thank you for the compliment. The NSCC's collateral requirements here serve the function to provide security for the stock settlement process goes through. So while an investor thinks that what has happened is they bought a stock on the day that they make a trade, it really takes 2 days for the settlement process to clear. During that time, the brokerage firm, the DTCC, and the brokerage firm on the other side can remain at risk of that stock not actually clearing. And the collateral requirements are in place to mitigate the risk that the brokerage firm will not be able to make good on its promises to sell or buy. I didn't see any broad-scale failure here. The DTCC's collateral requirement was large, but understandable. And I think things functioned largely correctly.
My time has expired. I thank you all for your testimony, and I yield back, Madam Chairwoman.
Thank you,
Madam Chairman, point of order. I just like, Perlmutter, just to remind people to, when they're not speaking, to mute themselves, because there's a lot of feedback when the question is asked and the mic stays open and the people are answering the question. Just remind everybody, mute when you're not speaking, that's all.
Thank you very much. You heard Mr. Perlmutter. I would hope that every member would certainly do that. Mr. Sherman, you're recognized for 5 minutes.
Thank you very much. We've come to expect things on the internet to be free. When you're not paying for it, it's not free. You're the product, someone else is the customer. When you go onto Facebook and it's free, you're the product being sold to the advertiser, and your information is sold to God knows whom. So we now have a system where we're telling investors that it's free to invest to buy and sell stock. There are two ways to pay the folks involved in Wall Street for buying and selling stock. One is a commission, and you know what it is. And so we discourage investors a little bit from buying and selling stock because they have to pay a commission and they know they're paying a commission. The other way to do it is to give them a worse execution. Whenever there's a stock being purchased and sold, the market maker, perhaps Citadel, might be willing to sell the stock for $10.05, but will buy it for only $10. The difference is 5 cents. And so the issue is whether Robinhood and other people who are being told you get it for free are really getting it for free. Mr. Griffin, you're a market maker. You pay some brokers for order flow. You don't pay others for order flow. So when you pay for order flow, you're not making as much on the transaction. You have to pay some of that back to the broker. That's hidden the amount of that is hidden from the customer. The fact that it exists has perhaps recently been disclosed. SEC rules require that people get the best execution, but I've recently learned that there's best execution and enhanced pricing. So if you get an order from Fidelity and you get an order from Robinhood and you're paying for the Robinhood order flow, is the Robinhood customer getting as good a price as the Fidelity customer? Mr. Griffin.
So, Congressman, I believe it's an excellent question. The execution quality that we can provide as measured in terms of price improvement is heavily related or correlated to the size of the order that we receive. So if I were to speculate,
don't tell me that that there are other factors involved and take us down another road. I'm asking you a clear question. Assuming same size of order, one comes in from Robinhood, one comes in from Fidelity. Is it not true that one is going to get a enhanced best execution and the other one is just going to get best execution?
So as I was trying to explain, because the Robinhood order comes from a community of traders who tend to trade in smaller size.
That isn't my question, sir. You're evading my question by making up other questions. Let me repeat. 2 identical orders come in. Same stock, same quantity. One's from Robinhood, one's from Fidelity. What happens?
The quality of the execution varies by the channel of the order. This is a commonly understood phenomenon in economics that channels matter. So, for example, when you go get a mortgage from JP Morgan to their clientele has a different rate of interest than a mortgage.
Okay, let me reclaiming my time, sir. Who gets the better deal? The one that comes from a broker who is being paid for order flow, and one not. Can you testify that on balance there is no difference, assuming the same size of the order?
So, as I said earlier, size of the order is only one factor.
You are doing a great job of wasting my time. If you're going to filibuster, you should run for the Senate. Everyone else I've talked to in this industry says when you pay for order flow, you get when your broker is being paid for order flow, you get a worse execution. Otherwise, you're in a peculiar circumstance where you're making more money on a Fidelity transaction than a Robinhood transaction, which would be an absurd business practice.
The gentleman's time has expired. Mr. Lucas, you're recognized for 5 minutes.
Thank you, Madam Chairman, for holding this hearing, and thank you to the witnesses for agreeing to testify. It's been reported that approximately 20% of market volume is now attributable to retail customers, which I think is just fascinating considering that's up from 10% in 2019. And that's an overwhelmingly positive development, allowing for more market liquidity, more stability, additional avenues for households to grow their wealth. And it's important to increase market access for retail customers. And I don't want to disrupt that if we possibly can. So I'd like to turn with my first question to Mr. Tennant. Let's talk about the attention that this pay-for order flow has received. You explained in your testimony, Robinhood's relationship with market makers is important for Robinhood's ability to offer commission-free trading. So expand, if you would, on how that process benefits the everyday investor. And just expand in general on that, if you would.
Congressman, I'd be happy to. Thanks for giving me an opportunity. So as I mentioned in my written testimony, payment for order flow enables commission-free trading. Prior to Robinhood changing the industry standard model to be commission-free, most brokers collected a commission on top of the payment for order flow on every transaction. Now, Robinhood routes to market makers, including Citadel Execution Services. We've got 7 in total across equities and options. And we route without consideration for payment for order flow. All payment for order flow arrangements are uniform across the market makers. And our system routes orders based on who provides the best execution quality for our customers. So the reason Citadel gets a relatively high percentage of our customer order flow is because they provide superior execution quality for our customers. And that's first and foremost the most important consideration that we look for. How are our customers getting the best execution quality? If another market maker were to improve upon the execution quality that Citadel Execution Services provides on any subset of orders, our system is set up to automatically route more traffic to that market maker.
Continuing down this line, because clearly this is one of the things that my colleagues and the public has a very strong interest in. And having lived through Dodd-Frank before, I see where sometimes major things can occur. I want to turn to Mr. Griffin. Now, could you also elaborate on how payment for order flow provides, whether it's the best price to the retail investor from the market maker perspective? Could you expand on that? As you outlined in...
Absolutely, Congressman. So as the CEO of Robinhood just set forth clearly, the orders that are allocated amongst the market makers today are allocated principally on the basis of price improvement. We have fought for 15 years to make that the basis by how which orders are allocated, because we strongly believe that Citadel is able to provide a better execution for retail orders in the long run. We make a huge investment in our team and our technology to do so. How is it that we are able to provide better execution quality than exchanges? Because exchanges are limited in their ability to do business by regulatory mandate. Exchanges by law have a minimum 1 cent wide market, which for low price securities means that they are less competitive than they otherwise could be. We're able to
No, are you here and what are you doing?
Excuse me?
That wasn't either one of us. Continue, Mr. Griffin.
All right. So we're able to share our trading acumen with retail investors, and we're able to give them a better price, and we're able to make payments for order flow to firms like Robinhood that allow them to have lower, or today in most cases, no commission. And of particular note, we're able to help Robinhood and other brokers pay exchange fees to the exchanges at the time of execution. This has been very important to the democratization of finance. It has allowed the American retail investor to have the lowest execution cost they've ever had in the history of the U.S. financial market.
In the Dodd-Frank process that the chairman and I went through a decade ago plus, there was much discussion about margin requirements. Give us just a discussion for an instant about when you discovered you had a $3 billion additional margin call.
So, thank you, Congressman. I believe the full play-by-play of that situation was described in detail in my written testimony. Just to clarify, though, this decision had nothing to do with margin.
Unfortunately. Thank you, Madam Chair. I yield back.
Has expired. Mr. Meeks, you're recognized for 5 minutes.
Thank you, Madam Chair, for this hearing, and Mr. Ranking Member. Let me ask a question to Mr. Taneev. I've been burnt once or twice in the market, and but particularly since I've been a member of Congress, one of the things that I recall greatly was the financial crises in 2008. And it is, we thought that opening the market up, where people had adjustable rate mortgages, et cetera, they were able to get into the market, people who may not have been before, but a lot of disclosure had not happened. So they didn't look, nor was there was no documents to look at what their incomes were or anything of that nature. So we sold them immediately because they did know that the people would not be able to afford them and they would default shortly thereafter. Now, so I understand your model of trying to get more people, more democratization, but that means that there's now greater responsibility of ensuring that your customers have all of the information they need to assess riskier trades. Now, for me, the information that has to be digestible and accessible. Now, one of the problems I have, for example, you're allowing up to $1,000 to buy stocks on margin. And borrowing on margin is risky. So how do you disclose this? How do you make determination of individuals who are not the sophisticated investors and allowing them to buy these risky stocks that are on margin?
Thank you, Congressman, for the opportunity to address that. Let me set the stage a little bit by saying that about 2% of our customers borrow on margin. About 13% on a monthly basis perform an options transaction, and a much smaller number, around 3%, perform a multi-leg options transaction. So the vast majority of our customers are engaging in buy and hold activities and long-term investing on our platform. Now, to clarify your point on the $1,000 margin, that's actually something that we refer to as Robinhood Instant. And it's provided as a courtesy. When a customer initiates a deposit, we allow them access to up to $1,000 of that deposit immediately. Similar to how if you deposit a check at a bank, as a courtesy, they might provide access to those funds or a portion of them before that check clears. As for margin specifically, borrowing money on margin, the rules are very ironclad industry-wide. Obviously, Robinhood Securities conforms to all of the applicable rules. And Robinhood's product is in many ways more restrictive than that of our competitors, because in order to even qualify for borrowing on margin, you have to be a Robinhood Gold customer, which involves paying $5 a month for the service.
So I think that you have, you say that everything is restrictive. But when you are going after the less sophisticated investor, it's more than that. There's a greater responsibility that you have because they could lose. And when they lose, it could make a determination of whether or not they can pay their mortgage or their rent or not. And they could be taken advantage of. Oftentimes we find in the financial industry, it is those that have the least that are really taken advantage of. So the big guys, it becomes a reverse Robin Hood situation, which really concerns me. Let me get to this real quick because it was just something else that you said in regards to liquidity. And you said that you didn't borrow the money because you needed it at the time, but that then later in a question you asked that you raised the additional money because I want to know how you spent the money for future situations, which means to me that you did have a liquidity problem or you anticipated possibly having a liquidity problem or would have one in future transactions. Could you, what's the deal there?
I appreciate that question. I stand by what I said. Robinhood was able to meet our deposit requirements. We were in compliance with firm net capital obligations throughout the period. And that additional capital, the $3.4 billion, wasn't to service our requirements. It was entirely to prepare for a future, even greater black swan event, and to unrestrict and remove restrictions on the trading and the buying of these securities.
The gentleman's time has expired. Mr. Huizenga, you're next with 5 minutes.
Thank you, Madam Chair. And this would have been a little nicer 10 minutes ago when I was supposed to go, but I'm going to go back to Mr. Griffin and the of the Capital Markets Subcommittee. Ranking member, I think, was filibustering himself, and I just wanted to make sure, Mr. Griffin, you had that opportunity to feel comfortable with the explanation of that best execution and what was attempted apparently to try to be asked.
Congressman, I hope so. I think it's important to emphasize that we have vigorously advocated for execution quality to be one of the dominant decision-making factors in the routing of order flow in the United States. This has saved retail investors billions of dollars over the year, in contrast to the executions that they would receive through other execution strategies.
Okay.
With respect to payment for order flow, we simply play by the rules of the road. Payment for order flow has been expressly approved by the SEC. It is a customary practice within the industry. If they choose to change the rules of the road, we need to drive on the left side versus the right side. That's fine with us. I do believe that payment for order flow has been an important source of innovation in the industry. As the CEO of Robinhood has testified, they drove the industry towards $0 commissions. This has been a big win for American investors.
Get to Ms. Sculp from Cato Institute. And I know that there was Greenwich Associates had a study and others are out there. Do you concur that this has been good for consumers in the most part?
I think that there's still ongoing studies, but I do think that payment for order flow and the price improvements have largely been good for improvements for customers. And I agree with Mr. Griffin that this has helped drive innovation in the industry. I think disclosure can always be better, and I think people should understand that their broker still needs to make money even if they're providing a zero commission trading service.
Yeah, okay. All right, I've got about 3 minutes left. I was going to start actually with this and ask each one of you why you thought you were here today. But I'm going to dispense with that because it's going to take too much time, and I'll provide the answer. Political theater for the most part. That's what this hearing is today. I mean, we're on the business channels right now and on C-SPAN. I think if you see a few of my colleagues playing to the cameras, but we need to have some of these fundamental and important questions answered at the end of the day. And one of the assertions that you've heard already today is that investing is, quote, casino gambling. It's using monopoly funny money. You know, I guess I want to know, is individual retail participation in the marketplace gambling, casino gambling, or using funny money? Mr. Gill, why don't we just start with you? Very quickly. I don't hear him. Mr. Huffman, let's move to you.
No, I believe that investing is investing.
Okay. Mr. Griffin?
I believe the vast majority of retail participation are people saving to meet their dreams.
All right. Mr. Tenev?
Congressman, thank you. As I mentioned in my opening statement, Robinhood customers have essentially made over $35 billion in unrealized and realized gains on all of their assets.
It's been a thing for them, correct?
Absolutely, it's investing and it's building wealth.
Go back to Mr. Gill.
Yes, of course. I do. I believe it's an opportunity for investors to participate in the market just as institutionals participate.
Okay, so actually the business channels had a good question from one of the Reddit readers, which is, So you recommended GameStop before. Would you buy their stock now at roughly 45? It started at 48 earlier today. You were talking about buying it and being happy when it hit cross 20. So are you buying that stock today?
Well, let me just say that investing can be risky, and my particular approach to investing is rather aggressive and may not be suitable for anyone else. But for me personally, yes.
So yes or no, are you buying the stock? And
for me personally, yes, I do find it's an attractive investment at this price point.
Quick question. Did you invest in GameStop because you were not aware of the payment for order flow? That's one of the accusations. People bought into this because they don't know that.
Sorry, could you repeat that question?
Did you buy GameStop because you were not aware of the payment for order flow?
My investment in GameStop was based on the fundamentals.
Okay. I think that answers it. I believe my time has expired.
Ms. Velasquez, you're recognized for 5 minutes.
Thank you, Chairwoman. Mr. Kenneth, Robinhood seems to have perfected the gamification of trading, providing the user with the perception that investing through the Robinhood app offers recreational gain, playing with little or no downside risk. Of course, many of us understand that investing is not a game and carries significant risk. How does Robinhood balance disclosures around the potential downside risk of investing, including the risk of substantial loss and the more enticing claims of profitability and the ease of trading?
Congresswoman, I appreciate that question. Giving people what they want in a responsible way is what Robinhood is about. We don't consider that gamification. We know that investing is serious, and we're investing in all of the educational tools and customer support to help people on their investing journey. What we see is most of our customers are buy and hold. A very small percentage are trading options, about 13%, and less than 3% borrow on margin. So most people use Robinhood to build up portfolios over time.
But can you answer my question? How do you balance disclosures around the potential downside risk of?
So we make lots of disclosures, Congresswoman. We also we're also a self-directed brokerage, so that means we don't provide advice and we don't make recommendations for what customers should or should not invest in.
So you don't think that as a result of the emphasizing profitability and ease of trading over the risk of loss, that many amateur investors were unaware of the situation they currently find themselves in?
Well, I want to mention again, as in my opening statement, Robinhood customers have earned more than $35 billion in unrealized and realized gains on top of what they've deposited. So I think this shows us that the product is working for customers and our mission is working.
Okay, thank you. Mr. Hawkins, over the course of my time in Congress, I have been concerned and spoken out about the dangers of short selling. While I understand that short selling can be used for legitimate purposes, too often I have seen abuse, and it ends up harming ordinary workers and families. I first saw it against the people of Puerto Rico, and now we are seeing it here against GameStop. Large investors, including hedge funds like yours, have to disclose their long positions when they own 5% or more of the company's shares, but not such disclosure is required for short positions. as we consider reforms, is this type of disclosure for short positions something you will support? Mr. Plotkin?
Yeah, Congresswoman, thank you very much for the question. I think it's a really good question. Whatever regulation is put forth in the marketplace, we will obviously, operate within those rules. It's certainly something I'd be happy to follow up with.
But what about my question about short selling?
Yeah, I think it's a really good question. It's not really for me to decide, but if those are the rules, I'll certainly abide by them.
Okay, well, I'm glad to hear that answer. Mr. Gill, public reports credit you with helping to start the GameStop craze by encouraging other amateur investors to bet against the short positions that Mr. Plotkin and others took. But the stock has now fallen from its high, and many amateur investors have lost hundreds of thousands of dollars. It is my understanding that you are a registered broker. Is that correct?
The gentleman's time has expired.
Okay. Thank you. I yield back.
Thank you, and I appreciate all of the members who are participating today. This is not political theater at all. This is serious oversight responsibility, and members are reminded not to impugn the motive of other members. Thank you. Mr. Lukemeyer, you're recognized for 5 minutes.
Thank you, Madam Chair. And my first question would go to Mr. Gill. Mr. Gill, I guess the question is, you're a very serious investor, somebody who does his homework, invest in the market, your own personal funds. And so I guess the question would be, here today, we're discussing the actions around Robinhood, all the transactions that took place. And I guess, do you think we need more legislation as a result of what happened here, or did the system actually work? And let me just make a couple comments on that part. From the standpoint that did it work, was it self-correcting? Did the fact that somebody like yourself was able to invest and maybe take advantage of the over-shorting positions by the hedge fund guys who were trying to really drive down the price of the stock for other reasons, whatever, or did it point out perhaps that we had some companies, perhaps like Robinhood, I would argue that was undercapitalized or under-reserved? Or maybe there was over-aggressive other types of investing that was taking place. The algorithms that were there, the different business models, they didn't work because you outsmarted the system, so to speak. Would you like to comment on that, on that sort of questions and how I formatted that?
Thank you for the question, Congressman. I would say my expertise is in analyzing the business, the fundamentals of the business, not so much on the inner workings of the market. I'm not so sure about legislation per se. What I would say is that increased transparency could help. That if someone like me could have a better understanding of how those types of things work, I feel as though it would be quite beneficial to retail investors.
Thank you for that. I know that Mr. Tevin, Robinhood has an interesting name. As I recall, the old story is take from the rich, give to the poor. And I assume what you're doing is allowing the poor to compete with the rich, which is interesting. You made the comment in your testimony, Mr. Tevin, about settling this in real time. We have the electronic ability to do this. I think that would probably help the situation that occurred here. But what other problems occur when you do this in real time? What other things would we have to look at? What other unintended consequences would there be if you did something like that?
Thank you, Congressman, for the question. I believe that right now, certain market participants rely on next day settlement to be able to take advantage of intraday netting and run up larger one-sided positions in certain stocks with the knowledge that they can close those positions or reduce them by the time settlement happens. And I understand that would be a limitation to the trading activities of some of these institutions. So that's certainly one area to consider. The other is around securities lending. We'd have to make changes to how securities lending works. I don't think any of these are insurmountable challenges, and I'd be happy, as I mentioned earlier, to deploy our intellectual capital and our team's engineering resources to help solve these problems very quickly.
Thank you for that. Mr. Plotkin and Mr. Griffin, the question is for both of you here. Whenever you're short selling, I understand that GameStop stock was short sold 140%. And Mr. Plotkin, you made the comment in your testimony a minute ago that you were not trying to manipulate stock. Yet if you're short selling a stock 140%, for me on the outside looking in, it looks like that's exactly what you're doing. Explain to me why that's not manipulating a stock.
Thank you, Congressman. For us, I can't speak to other people that were shorted. Anytime we short a stock, we locate a borrower. Our systems actually force us to find a borrower. So we always, short stocks within the context of all the rules.
Mr. Griffin, would you like to comment on that? You guys are both market makers and brokers and hedge fund guys. I mean, you do all of it. Why is this not considered manipulating a stock whenever you can short sell at 140%? Don't you think there should be a limit on something like that?
So I believe that the short interest in GameStop was exceptional, and I'm not sure it's worth us delving into legislative corrections for a very unique situation in terms of the extreme size of the short interest. I will say that all of the large market participants, in fact, every bank, every hedge fund does have to comply with the requirement to borrow shares to short shares in the course of their day in and day out business. The practice of naked shorting was largely curtailed by SEC mandate years ago.
The gentleman's time has expired. Mr. Scott, you're recognized for 5 minutes.
Thank you, Chair Lady Waters. And let me just say, Chair Lady, that the people of this country appreciate you for pulling this financial services hearing together, because this is a threat to the future of our financial system, and we got to get to the bottom of it. Let me start with you, Mr. Tenney. Let's go through this. The sequence of events that led to the extreme rise in value of GameStop stock and the subsequent market volatility originated through a Reddit discussion. And then that was fueled through social media. And as the story gained traction, tweets by well-known figures with the influence to move markets sent the stock value even higher and higher. So let me start with you, Mr. Tenney. What policies does Robinhood have in place to monitor what happened on social media and how it drives the use of your trading platforms?
Thank you for the question, Congressman. Currently, Robinhood does not perform any sort of moderation of social media. We simply don't have the data that the social media platforms have at their disposal to tie these posts to identities. We do, however, within Robinhood Securities, conform to all regulatory requirements around monitoring and trade surveillance and all things of that nature.
Well, Mr. Kenner, don't you see something is going terribly wrong here? What do you do to monitor the trades in individual stocks, particularly when, in the case of GameStop, they are singled out and moved on social media? What do you do?
I appreciate the question. So our priority throughout the exceptional market conditions in January and early February was to maintain the uptime and performance of our platform and make sure that we're available to customers.
Let me try to get to a point here. Do you, Robinhood, do you have any policies in place to ensure that investors are making trades based on legitimate, material, financial information and not the influence of social media, the design of trading platforms, or any other superfluous information? Do you have anything, any guard to that?
Absolutely. Congressman, we provide educational resources to our customers, including our redesigned Robinhood Learn portal, which is not just available to Robinhood customers, but to the general public, and had over 3.2 million people visiting in 2020.
But do we not, I mean, you're at the center of this. Don't you see and agree that something very wrong happened here and that you're at the center of it? And we are looking on this committee of how we can protect our wonderful, precious financial system. We need it from you. What about you, Mr. Hoffman? Do you have anything? What steps is your company taking to guard against this? Anything at all?
Congressman, we spend a lot of time at Reddit ensuring the authenticity of our platform. So we've got a large team dedicated to this exact task. Everything on Reddit, all of the content is created by users, voted on by users, and ranked by users. And we make sure that that is authentic and as unmanipulated as possible. And in this specific case, we did not see any signs of manipulation.
Madam Chairman, lady, I just want to conclude. I got maybe 10 seconds left, but this episode exposes a serious threat to our financial system when tweets, social media posts do more to move the market than material, legitimate information. The risk is enormous.
Thank you very much. Mrs. Stivers, you now have 5 minutes.
Thank you, Madam Chair. I appreciate you calling this hearing. The American financial markets, I believe, are the envy of the world, but they're still imperfect. I would have liked to seen this committee have a meaningful discussion about capital requirements and the T+2 clearing rules that may have contributed to some of Robinhood's customers not being able to purchase stock, including GameStop, for a period of time. But because the majority didn't include the SEC, the Depository Trust Clearing Corporation, or the National Securities Clearing Corporation to testify, we're left with what we have. That's because I believe the majority is attempting to use this hearing to drive a narrative about the U.S. capital markets being rigged. But I do have several questions. Mr. Tanev, you decided to stop allowing your users to buy GameStop and other stocks as a result of capital requirements on Robinhood Securities. Is that correct?
That's correct, yes. Deposit requirements with our clearing houses.
And you know, those got resolved, but for a period of time, some of your users could only sell and not buy, and that could have contributed to the stock actually going, you know, not going up as fast because some of your users were prohibited from buying. Do you think that is possible that could have happened?
I shouldn't speculate on what could have happened if
there's more sellers than buyers. Does the stock price go down or up?
Well, to be clear, Robinhood, Congressman, is a minority of trading activity in these securities.
I understand, but if your buyers can only sell and not buy, then it clearly keeps you from putting upward pressure on the stock price. Is that correct?
On Thursday, customers on our platform could only sell, so there was no ability to buy. That's correct.
Right. So, you know, I know, and you said earlier, by the way, I know some people have attacked your arbitration agreements, but I want you to be clear. If your users were harmed as a result of these actions, they can recover through arbitration. Is that correct? Yes or no?
Yes, that's correct. And our arbitration is FINRA supervised and overseen. And we do believe arbitration gives customers a fair and speedier resolution to their claims.
Thank you. Does your user agreement and your arbitration allow for group arbitration or only individual arbitration?
Let me get back to you on that.
If a group was treated similarly and similarly affected, or lost upside or lost money, can they do it as a group, or is it only individual in your arbitration agreement?
Well, Congressman, I'm sure you're familiar of the number of class action lawsuits filed against Robinhood.
And I'm not asking about a class action lawsuit. I'm asking, in your arbitration system, can a group of people come together, or as an individual? And this is not a trick question. I'm not a fan of trial lawyers. I'm just trying to understand.
Yeah, I appreciate the question, Congressman. I think the best thing I can do is get back to you after making sure that we get you the right answer.
Thank you. Thank you. That'd be helpful. Mr. Plotkin, are you a frequent short seller, yes or no?
We run a long short portfolio. The majority of our investments are long investments, but we also have short investments to hedge out market risk.
Thank you, Mr. Plotkin. Has Melvin Capital ever engaged in short selling of the stock Tesla?
We have been short Tesla in the past. That's correct.
Mr. Plotkin, also, this is a longer question. Did you see the tweet from Tesla CEO Elon Musk about GameStop stock?
I did see that after market hours on, on a Tuesday.
Do you believe that Mr. Musk's tweet had any significant effect of driving the rise in GameStop stock?
I don't want to speculate on what the actions of his tweet were. The stock did rise after hours.
Then do you believe that that tweet was targeting you because you had shorted Tesla stock in the past?
We had a very small short position years ago in Tesla. That would be pure speculation as to his motives of putting that tweet out.
Okay, thank you. I'll go back to Mr. Tanev on the regulatory requirements. Do you believe that the SEC and the Depository Trust Clearing Corporation should modify any of their rules as a result of what happened to your users because of capital requirements?
I do believe.
The gentleman's time has expired, and the SEC is not here today because they're in transition with a temporary chair, awaiting the confirmation of the person who's been appointed by the President of the United States. This is a serious hearing. Members are reminded not to impugn the motives of others. Thank you, Mr. Green. You're recognized for 5 minutes.
Thank you, Madam Chair. Ms. Schultz, there is a reason for penalizing a market maker for improperly trading its own accounts ahead of its clients' accounts. Note that I said improperly trading. I don't want to go through the scenario of there being a time for proper trading ahead of accounts. I'd like for you to tell us what that reason is, please.
Well, trading ahead of customer accounts is illegal, and it does not.
I understand that it's illegal. Yeah. I don't mean to be rude, crude, and unrefined, but I have to ask this question quickly. What can happen that can benefit the market maker? How can that be monetized such that the market maker profits greatly from doing it?
Right. If a market maker trades improperly ahead of the own customer accounts, he can get a better price and can move the market in the process depending on how big the trade is, thus hurting the customer.
Yes, and if this trade is huge, and you can see that this trade that the client has is huge and will have an impact on the market, how does that benefit the market maker to trade ahead of the client?
The market maker can get a better price for himself before the price changes by the client's trade. He can also engage in self-dealing that way as well.
So does it benefit a huge market maker to have a great deal with, let's say, a Robinhood because of the flow that will be coming through that the market maker can take advantage of?
I don't think that they're necessarily congruent situations. When you're trading ahead of a customer order, which is something that is illegal and that the SEC does monitor for, it's very different from having knowledge as to the way that the market might be moving based on...
I understand, but I want to talk about the circumstance where it's improper, not where it's proper. Remember, we started with improper trading. Here's my point. Let me go to it quickly. The market maker Citadel traded over-the-counter stocks for its own accounts in 2012, from 2012 to 2014, while simultaneously delaying client orders for the same shares. And it was fine for this. Citadel has been naughty for some time. 2014, Citadel faced $800,000 in penalties. 2017, 22.6 million. 2018, 3.5 million. 2020, 97 million. And another 2020 of 700,000. This seems like a lot of money. It is for me, more than $124 million. But over the same period of time, Citadel had revenues generated in the amount of $13.2 billion. It seems to me that the punishment for these improper trades and improper actions, because it wasn't just trading, Citadel also did some other things that were not proper. They misled clients. Seems that the punishment is so small given the amount of revenue generated over the same period of time. It seems that Citadel has at least an opportunity to build into its cost of doing business paying penalties. And that concerns me. It concerns me that the punishment doesn't seem to deter Citadel. It concerns me because I know of circumstances wherein persons who are not in the market, they do things that are much less harmful, and they can possibly go to jail. So the question that I have is this: what kinds of systems do we have in place, and it's back to you again, ma'am, to prevent the very things that I have called to the attention of my colleagues?
Well, as a former enforcement attorney at FINRA, I can say that regulators have the same concern with fines and other punishments becoming just the cost of doing business. And it's one of the things that are considered along with the regulations around what can be punished.
The gentleman's time
may I, for the record,
has expired. Mr. Green, as you know, we're going to have a series of hearings, and our next panel will include a whole bevy of experts also on some of these issues. With that, Mr. Barr,
may I say something in the record, please? I have additional questions.
Without objection, you may enter into the record. Thank you.
Thank you.
Mr. Barr, you're recognized for 5 minutes.
Thank you, Madam Chair. And Mr. Griffin, I want to revisit this issue of payment for order flow. Payment for order flow has been around for decades, correct?
So I know it's been around for at least 1 or 2 decades. I can't answer before that period of time.
And it's a recognized and approved practice by the SEC, correct?
Yes, it is.
And payment for order flow is set by the brokerage firm, not the wholesaler, right?
It is ultimately a negotiated number, but it is a number that is set by the brokerage firm and not by us as the market maker.
Well, as a market maker that provides execution services to retail brokers, you are required to meet best execution requirements. Is that correct?
Yes, it is.
And in other words, market makers are required to provide the same or better pricing than the exchanges, correct?
That is correct.
And how can market makers offer that better pricing to Mr. Sherman's line of questions?
So there are a number of drivers that permit us to offer better pricing than what is available on exchange. The first is that exchanges have legally mandated minimum text sizes of a penny. So if you look at a stock like AMC, it trades $5 bid, 501 offered. If the exchange could trade with a half-cent increment, it would probably trade $5.005 bid, 501 offered, or vice versa. But the exchanges are limited to a 1 cent minimum tick size. And we have been clear on the record in prior testimony that exchanges should be permitted to have a smaller and more competitive tick size. That's fact number one.
Okay.
Fact number two is that the average retail order is much smaller in totality than the average order that goes onto an exchange. Because this order is smaller, and I'll share a number with you, the typical Robinhood order is ballpark about $2,000 in size. Because it's a small order, the amount of risk that we need to assume in managing that order is relatively small as compared to an order that we have to manage from our on-exchange trading. And as I'm sure you're well aware, we are the largest trader of stocks on exchanges in the United States. So
let me move to Mr. Tenev really quickly on that point. What impact might greater restrictions on the payment for order flow model have on your ability to offer zero commission trades?
We do believe, Congressman, that that's an important question, and payment for order flow helps cover the costs of running our business and offer commission-free trading to customers. When we started, people didn't even think that there was enough margin left to make this business work, but we've been fortunate to make it work and to make it work for our customers.
Well, let's talk about why Robinhood restricted trades. I think your explanation about margin requirements charged by your clearinghouse makes sense. Is your clearinghouse supervised by the Fed and the SEC?
I believe that's
are the margin requirements charged by your clearinghouse in turn approved by federal regulators?
Yes.
And did federal regulators approve the value risk charge that was imposed on Robinhood?
I believe, Congressman, the value of risk charge is outlined in general terms in Dodd-Frank, but I'm not sure who approved the specific implementation of that formula.
So if anyone has a problem with your decision to halt trades, it's fair to say that their frustration should be directed toward federal regulation.
Congressman, I'm not trying to throw anyone under the bus and direct frustration anywhere. All I can say is Robinhood Securities played this by the books and played it basically the only way that we could remain in compliance with our deposit requirements.
Mr. Plotkin, appreciate your testimony that Melvin always follows laws governing shorting stock, but Melvin lost $6 billion in 20 trading days. Let me ask you about your risk management. Did your short positions exceed float?
No, they did not.
Well, shorting has an important role to play in our markets, allowing for legitimate hedging and price discovery. But we are interested in naked shorting, and so we would hope that you would clarify that and how it is that you make sure that you're first locating the borrow.
Just has expired. Mr. Cleaver, you're recognized for 5 minutes.
Thank you, Madam Chair. And I too would like to thank you for this hearing. It's a question that a lot of people are asking, probably many of us as we go throughout our districts. But let me start with you, Mr. Tenev. I'm just curious if you can give it to me in a short period of time. How did you come up with your name for your company?
Absolutely. Thank you for that question, Congressman. Robinhood stands for lowering the barrier to entry and democratizing finance for all. So the idea is the same tools that institutions and wealthier, high net worth individuals have had for a long time should be available to the people, regardless of their net worth or how much money they have.
Okay, I appreciate that answer. Because it's something I would also embrace. However, I have a 23-year-old on the other side of the house who I love dearly, but he has no training, no income, no qualifications. How in the world could he get like $1 million worth of leverage?
Thank you, Congressman. So the leverage that we provide to our customers, which less than 3% of our customers actively use, is regulated strictly by requirements. So the only way to get that amount of leverage in a margin account through borrowing is to deposit a similarly sized amount of capital.
Or by mistake?
Congressman, I'm not sure what you're referring to.
Well, I mean, there's a record of a young man getting $1 million worth of leverage. He was only 20 years old. So I'm just saying, you know, if that's not a policy, that was an error.
Congressman, I appreciate the opportunity to address that really important point. You're referring to Mr. Kearns.
I am.
The man who unfortunately passed last year.
Yes.
First of all, I'm sorry to the family of Mr. Kearns for your loss. The passing of Mr. Kearns was deeply troubling to me and to the entire company, and we have vowed to take a series of steps, very aggressive steps, to make our options product safer for our customers, including changing the customer interface, adding more additional options education, as well as strengthening and tightening the requirements for people getting options, and adding a live customer support line for acute options cases. So it was a tragedy, and we went into immediate action to make sure that we made not just the most accessible options trading product for our customers, but the safest as well.
Okay, I asked a question. In my real life, I'm a United Methodist pastor, and so I've read your statement. After the tragedy of this young 20-year-old, but I mean, and I don't think you nor I want to get in. I mean, to litigate that right here today. But you know, what improvements did you make in the aftermath to your platform, or were there improvements?
Thank you, Congressman. There were several improvements. One, we added the ability to instant exercise as well as exercise options positions in app. We clarified the display of buying power, specifically negative buying power, in situations where one leg of a complex multi-leg options transaction were to be assigned. We also added an options education specialist. We also added live phone-based customer support for acute options cases, which has gotten very, very great feedback from customers and is something we're expanding to other use cases, such as cases where customers' accounts have had off-platform hacking incidents.
Okay, that's the last one is where I was concentrating on, because this young man was trying to get into your system to find out what was going on. He was confused, he was scared, and so he sent emails. And so, to be fair, there was a response, but it was like, hours later. And so as I became more and more familiar with this particular case.
The gentleman's term has expired.
Thank you, Madam Chair. Appreciate it.
You're so welcome. Mr. Hill, you're recognized for 5 minutes.
Well, thank you, Madam Chair, for holding this hearing, and I want to thank our witnesses for their expertise and their patience. Madam Chair, I have a letter from the American Securities Association I'd like to insert in the record, please.
Without objection, such is the order.
Thank you very much. And Mr. Tenev, what a treat to see you, and congratulations on being part of the American dream. I had the pleasure working for President Bush 41, of working in Sofia in 1990 and 1991 to try to bring capitalism to Bulgaria after the wall fell. So I'm glad to see you're an American citizen and innovating here in our country.
Thank you.
I think you've done a good job talking about I'd say the acknowledged lesson that you've learned in terms of these deposits for clearing and the important risk management issue for your firm. So I'd like to turn to follow up on some of the discussions about retail service that you've also touched on today. Do you have a call center generally for Robinhood investors?
Thank you for that question, Congressman. And I want to start by saying customer service is fundamental to everything that we do, and it's one of the areas where we're investing the most. We have customer service centers in a number of states: Colorado, Florida, Texas, and Arizona, and we're looking to expand aggressively.
Well, do you have a call center that I can call, a 1-800 number, if I'm having a trouble in the middle of the trading day?
We do offer, Congressman, live phone support in-app for certain use cases. We're expanding that as fast as we can. Yeah. So as I mentioned earlier, options, advanced options cases, as well as account takeovers, which typically happen through a customer's personal email who's been compromised. And the feedback's been great, and we're looking to expand the live phone channel, as well as make improvements to our email channel and even upstream within the product.
Thank you. That's helpful. And on the subject of margin and options, you've talked about that today. But I've spent 40 years in this business and been the general securities principal in 3 different firms. And this issue of granting margin and option approval to retail clients is always an important issue. You've addressed that today, so I want to turn to a different topic that has not been raised, and that's low dollar stocks. As I understand it, your policy and procedure manual simply said that you allow low dollar stocks if they're on an exchange, but many brokerage firms are very reticent to allow retail investors to invest in stocks that are under $5. Could you address that issue today?
Yes, I'd be happy to, Congressman. So Robinhood allows customers to trade in and invest in exchange-listed securities. So that's the objective criteria that we use. And it actually excludes several types of securities that customers commonly request to trade in. So on Robinhood, you can't trade over-the-counter bulletin boards, except in limited cases where a listed stock falls to over-the-counter. You can't trade pink sheets. And of course, you can't short sell or enter undefined risk options trades. Okay. So our objective criteria involve whether exchanges list these securities.
Thank you. And I think that probably, I'm sure you'll reevaluate that after these effects. Let me turn to Ms. Schulp. Thank you for being here. The Wall Street Bets Reddit platform. I'm curious, when you think about the obligation of this SEC pending investigation, based on your FINRA background, do you think the SEC should look at the bulletin board participants under Section 9A2 on potentially inducing trading in a certain direction? Is that worthy of their review?
Thank you for the question, Congressman. I think that there's been little evidence to this time that there's been any sort of false or deceptive conduct taking place on the Wall Street Bets forum. That does not mean, though, that I think that the SEC should not take a deeper look. Because of the anonymity in the forum, there could have been people that were engaging in deceptive behavior that's not readily apparent to outside, to the public. So I do think the SEC should look, but to this point, I've seen very little that would meet a test for manipulation, which generally involves false or deceptive behavior.
Thank you, I appreciate that. Mr. Tiev, I thought of another question for you. Would a securities transaction tax be beneficial to retail investors in the United States?
Thank you, Congressman. I don't believe it would.
Thank you.
Gentlemen's time has expired.
Thank you, Madam Chair. You're back.
Witnesses, we will take a short recess. The committee stands in recess for 5 minutes. Thank you. You're recognized for 5 minutes.
Thanks, Madam Chair. Mr. Gill, let's start with you since you seem to have started all of this. You began analyzing GameStop in the summer of 2019. Was that your testimony?
I wanted to know. Yes.
Congressman, I've been following GameStop for a number of years. I started to buy into it in June of 2019, most recently.
Hey, so back then, what was the price of the stock when you started investing in it?
At the time, it was in the ballpark of around $5 per share.
Okay, and in your analysis, what did you think a proper price for the share was? Because you thought you were getting a good buy.
Sure. At the time, I thought that the value of the business could be worth up to roughly $2 billion.
Okay, but how much is that per share? Just bring it back to you bought it 5, you thought it was worth 10, 20?
I felt as though that it could be worth at the time in the range of say $20 to $25 per share.
Okay. And you continued to invest on and off through 2019 and 2020. Is that true?
Yes.
Okay. And you also, you bought long, you bought some shares, but you also did some options trading, did you not?
Correct. I did.
And options trading is not really for the novice investor, is it?
It is a riskier investment, yes.
Okay. On January 27th, I think the stock price hit $483 or something like that. Is that true?
I believe it was in that area, yes.
In your analysis, back when you started investing in the stock, did you ever see it being valued at $483 per share?
At the time, I thought it was possible, but a very low probability, I thought.
Okay, thank you. Just a couple more questions. In terms of the platforms where you visited and discussed this stock with others, one was the Reddit, subreddit, Wall Street Bets platform, correct?
Correct.
And at any given time, how many people were you talking to on that platform?
I wasn't so much talking to anyone individually, but rather making posts on that public forum.
That GameStop was an attractive stock.
Yeah, early on, I had felt that it was an attractive investment opportunity, and I had shared some of my thoughts as to why that was.
Did you discuss this on any other platforms? Are there any other kinds of Reddit or other kinds of platforms that you talked about the stock?
Yes, I have talked about the stock on some other platforms.
Okay. Did you ever talk about the short sellers that had bet against this company?
Yes, the topic did come up.
And about when did that occur?
Oh, since around the time I had begun investing in it, it was, as someone else has noted, it was an exceptional level of short interest in the stock since the time I had started investing in it.
Okay. Let me turn my attention now to you, Mr. Plotkin. When did Melvin first take a short position in GameStop?
Thank you, Congressman. That was in 2014, really right at our inception of the fund.
And when you did that, did you continue to maintain a short position?
That's correct.
So you said you analyzed the value of the stock, and you, by taking a short position, you, unlike Mr. Gill, thought that the stock was overpriced. He thought it was underpriced. You thought it was overpriced.
That's a good conclusion. Yes.
Okay. In your analysis, when you started into the short position, what do you think the stock was worth?
I don't remember exactly at the time. I think when we launched, it was probably a $40 stock. I think we believe the company had a lot of structural challenges. We've seen their earnings go from, I think, north of $3 a share to almost negative $3 a share. So there's been a lot of challenges fundamentally.
All right. Last question for you. Were you in a naked position in your short position because the stock was oversold?
No, our systems won't even allow that. So that would be impossible for us to do.
Okay. Well, thank you. My time's expired. I wanted to get some facts out for Mr. McHenry, and I yield back.
Thank you very much. The gentleman's time has expired. Mr. Emmer?
Thank you.
Nice for 5 minutes.
Thank you, Madam Chair, Ranking Member McHenry, for holding this hearing. Thank you to the witnesses for being here today. I represent the 1st Congressional District of New York, which encompasses much of Suffolk County on Long Island. My home district is full of people from all different walks of life and industries, and having access to cost-efficient investing is crucial. While there are always ways to make a system work better, our capital markets are the envy of the world with their liquidity and diversity of investment opportunities. Innovations in securities trading brought by the private sector have increased access for retail investors. For better or for worse, and this situation is a perfect example. For example, one of our witnesses here, Mr. Gill, or should I say Roaring Kitty, turned $53,000 into almost $50 million, and that's what you would call some deep you-know-what value. Of course, we know that not all those who invested in these stocks share the same success story. However, I want to highlight a potential vulnerability in these innovations. I've been concerned for some time in general with the sharing of U.S. individual user data with the Chinese Communist Party. I sent a letter, for example, to the Treasury Department in October 2019 expressing concern with the potential sharing of user information by TikTok to its parent company ByteDance and asked for a CFIUS review. Chinese companies are required by law to regulate online behavior that deviates from the political goals of the CCP, obey the CCP's censorship directives, and participate in China's espionage. These policies regulate companies like TikTok in the China market and increasingly their overseas business. Webull and Moomoo are two examples of broker-dealers that are subsidiaries of Chinese parent companies. According to Bloomberg, funds affiliated with Xiaomi Corp own at least 14% of Webull. Xiaomi is a Chinese company that risks being delisted from U.S. exchanges after the U.S. Department of Defense put the company on a blacklist on January 14, 2021. Moomoo is owned by Futu Holdings, which is a company that received a significant investment from entities affiliated with Tencent, a company with known ties to the CCP. On December 8, 2020, Bloomberg Businessweek ran an article on Webull stating the company, quote, has increased its roster of brokerage clients by about 10-fold this year to more than 2 million by offering free stock trades with a slick online interface. On January 29, 2020, the day after trading activity for long trades on certain stocks discussed on Reddit threads were limited, Bloomberg ran an article with the headline, Robinhood rival Webull sees 16-fold jump in new trading accounts. It's clear that these apps have rapidly increased their user base, which has me concerned. Ms. Schulp, do you think we should be concerned about the potential for Chinese entities with ties to the CCP receiving personally identifiable information or other user data from their subsidiary broker-dealers that are licensed and registered in the U.S.?
I think it's a potential national security concern, which is a bit outside of my area of expertise. What I can say is that the rules that the brokers have to apply and comply with regarding personally identifiable information and other material data should be applied equally to companies that are based offshore and companies that are based onshore. And I hope that that's the case with respect to Webull or any other competitors that are not domestically owned.
Having a diversity of choice for different trading apps is generally good for market competition. However, is it a good outcome for millions of Americans to flood into trading apps that could be required to share user data to parent companies that have ties to the CCP?
Again, I think choice is key here, as well as understanding from a consumer perspective what companies you are choosing to do business with. Again, the national security concerns are a bit outside of my area of expertise.
Well, I thank you for being here. This is another angle to this issue with these new options that are being provided to average retail investors. And we want these retail investors to have the most amount of information as possible to be set up for success. I yield back.
Thank you very much. Mr. Himes, you are recognized for 5 minutes.
Thank you, Madam Chair, and a big thank you to our panel today for a very interesting conversation. One of the chairwoman's ways of characterizing this hearing was who wins and who loses. And I've spent a bunch of time in the last couple of days looking at the various players here. I'm pretty convinced that the wholesalers, Citadel is one of the winners. They make a lot of money. They're the casino in this story, and the casino tends to win over time. Robinhood has a valuation of $5.6 billion and makes a lot of money from the casino. So who loses? And I want to spend some time talking about the person who usually loses, and that's the retail investor. And while I have supported for many years the democratization of finance, as we say, it's not just in Washington, D.C., but on Wall Street. The retail investor is known as dumb money. And there are any number of structures that are set up to take advantage of the retail investor. And I think it's worth looking at that, because as much as we're celebrating Mr. Gill here, we're not talking very much about Mr. Salvador Vergara, who was featured in a Wall Street Journal story, who took out a $20,000 personal loan through Robinhood, invested it in GameStop, only to see the value of his position go down 80%. So Mr. Vergara is out $16,000 he doesn't have, that he owes to somebody else. And as much as I support the democratization of finance, we need to be thoughtful about this. So Mr. Tenev, my question is for you. You quoted a $35 billion number as what I interpreted to be profits in excess of deposited funds and securities. If you just look at your customers who traded in GameStop over the period of its increase and subsequent decrease, Mr. Tenev, how did your customers in the aggregate do? Did they win or did they lose?
Thank you, Congressman, for that question. I don't have that particular cut of the data top of mind, so maybe we can get back to you on that one.
All right, you don't have that. So you do have a $35 billion figure. The figure doesn't mean a lot to me because it's just a dollar number. Help me convert that to a rate of return. First of all, is that $35 billion, is that gross or net? In other words, is that actual profit, or does it include margin shares, other forms of leverage that may actually not belong to the account holder?
It does include, Congressman, unrealized gains. So it's the value of assets, both including positions in securities and cryptocurrencies.
Okay, I get that. I get that. But again, 35 billion doesn't mean anything to me unless you can convert that into a rate of return. So do that for me. What is that on what asset under management number is that 35 billion unrealized against?
The asset under management number is not one that Robinhood has publicly shared.
Okay, but you can't share $35 billion. Sorry, Mr. Tenev, I just don't have a lot of time. $35 billion is a meaningless number. I need to know what that is in terms of return. So convert that for me into rate of return. So I can compare it to Treasuries, so I can compare it to the S&P 500.
Congressman, with respect, I think the proper comparison is to customers not investing at all. Much of our customers are investing for the first time and are taking money that they otherwise would have spent or consumed and putting it.
Mr. Tenev, again, I don't want to be rude, but it's my time. Again, you offered up the $35 billion number, which, as you and anybody else schooled in finance knows, is meaningless unless you convert it into a rate of return. So just please convert that $35 billion number, which to the folks watching at home sounds like a lot of money. But what does that actually convert to in terms of rate of return, which is what matters?
Congressman, $35 billion is indeed a large amount of money, especially for our customers who are mostly small investors. It's more than most corporations, nearly all corporations have paid.
Mr. Tenev, again, don't make me be rude here. You and I both know that $35 billion of unrealized gains, if that's on a base of $100 billion, that's a 35% of return. If that's under $1 trillion, it's a radically different rate of return. So what I'm trying to get at, Mr. Tenev, here is you threw out the number of $35 billion. I actually think the right comparison is, what if your clients had simply invested in the long run in an S&P index fund? Would that number be more than $35 billion or less?
Congressman, with respect, I don't believe the right comparison is investing in an S&P index fund. I think the right comparison is not having invested at all and having instead spent that money and consumed it.
No, it's most certainly not. It's most certainly not, Mr. Tenev. And so I'm going to ask you, I'm out of time, but again, you put out the $35 billion number. So I think it's only decent, because you and I both know that a hard dollar number is meaningless unless you can convert it to return. So I'm going to ask you to convert that, obviously I'm out of time, into a rate of return for us.
You're out of time. Mr. Laudermilk, you now recognized for 5 minutes.
Thank you, Madam Chair, and I appreciate all the members of the panel being here. I think you've seen that there are occasions with some on the committee here that if you're not giving them the answer that they want, that they can use, they're just going to continue to push on you. And I just encourage you to continue speaking the truth, and you'll always stand up head and shoulders above everyone. Not surprisingly, the situation with GameStop trading has resulted in commentators and even some of my colleagues engaging in knee-jerk reactions, calling for new laws and regulations to be hastily enacted. It just seems to be a trend in Washington, D.C. to never let a crisis go to waste. Some have even spread conspiracy theories and alleged that crimes were committed before knowing what even happened. I can even testify to what was just being said is I know numbers of people, personal friends, who have never invested before, but because of Robinhood and other retail platforms, many of them took the stimulus money that they received during the CARES Act, which they were still working, they didn't need, and they actually started an account and started investing. So yes, more and more people who have never invested before are now investing using these platforms. This hearing is a reminder that with complex situations, we should take time to understand what actually did or did not happen, especially with this GameStop situation. Now, the SEC is the proper authority to determine if any rules were broken, and they are looking into it. Congress has already given the SEC broad authority to oversee the capital markets, and we do not need to rush to enact even more big government regulations until we that could ultimately harm the investors. Now, question, Mr. Tenev, can you remind us again why Robinhood temporarily paused trading of GameStop and other stocks?
Of course, thank you, Congressman. Robinhood paused trading temporarily, or I should say paused buying of about 13 securities on Thursday so that we could meet our regulatory deposit and collateral requirements.
Okay, so what you're saying is you were paused because you had to comply with regulations. Is that true?
Correct.
All right, so it's ironic that the people who are criticizing brokerage firms because they pause trading, which they sometimes have to do to comply with regulations, these same folks are now saying we need to respond to this with more regulations. I would say if people don't like brokers occasionally having to pause trading, I'd suggest they look at the regulations that required it. At some point, we need to recognize that piling on more and more regulations only increases complexity and does not help investors. Question for Ms. Schultz. Despite the volatility and the frenzy of media and social media activity, it seems to me like the markets functioned as they were supposed to during this situation, and that markets are not broken. In fact, they are working well. Do you agree with that?
I agree with that.
Okay, thank you. I appreciate that. I think most reasonable people that are listening to this would agree that there are regulations in place. The SEC has those to pause activities that could be harmful, not only to the markets, but to the individual investors. And so what I'm understanding you saying is that it did work in the way it was supposed to.
As
Address what some of the issues are in the T2, T1, and T0 debate?
So, Congressman, I cannot profess to be an expert on these issues, but I will give you my perspectives from having been in the industry for 30 years. We started at T5. We will one day be at real-time settlement. And the question is how long does that journey take? From T2 to T1, which reduces the amount of capital required by broker-dealers to meet the needs of their customers, that reduction in capital will be meaningful, would have been very helpful to Robinhood during this period of time. Reduces counterparty risk holistically, which is good for everybody in the market. We should push for T1. As we go to same-day settlement, you now bring into question the complexity of intraday cash movement, and you bring into play the necessity for all systems to be functioning every moment of every day with no room for error. On a T1 settlement cycle.
This time has expired. Let me remind the members that we're going to have a series of hearings. Today is the first. There will be probably two more. I didn't hear anyone here today say that they were ready to pile on regulations. So let's make sure we know that our statements are accurate. Mr. Foster, you're recognized for 5 minutes.
Thank you, Madam Chair, and to our witnesses. Mr. Tenov, I'd like to follow up a little bit on payment for order flow and best order execution issues. Democratization of finance is a good and noble goal, but for democracy to work, consumers need transparency and high quality information, and not only about fees, but about order execution quality. Your customers actually don't care directly about who you subcontract order execution to or any payment for order flow, but they need a simple way to compare the execution quality between your app and competing apps or other accounts. And while institutional investors can afford to run their own tests, and they do, and I'm sure Mr. Griffin is normally is quite often on the receiving end of those tests and trying to measure up to his competitors to compete for market share there. The institutional investors have the market power to demand best execution statistics for their prime brokers. And everyday investors do not get the same transparency. In fact, I believe there's an SEC rule 606 that requires brokers to disclose at least some order execution data to institutional investors, but this requirement does not apply to retail investors. So, Mr. Tenov, since Robinhood's mission is to democratize finance for all, I ask, what are the mechanisms that you would accept and support to provide transparent order execution quality statistics so that your customers can engage in a clean apples to apples comparison between other brokers, between your app and other people's apps in terms of the total cost of trading?
Thank you, Congressman, for that very important question. I'm generally in favor of a greater amount of transparency than what we've typically seen in the financial industry. And recently, Robinhood and me personally have engaged publicly on the topic of payment for order flow, short selling, and of course, T+2 and real-time settlement. We do publish 606s via Robinhood Securities that detail our payment for order flow arrangements with various market makers. And just this past year, the industry implemented more detailed 606 requirements, which we of course conform to. Also, back in December of 2020, we released a public page on our website that provided detail about the execution quality, including price improvement that our customers received. And we're proud to announce in 2020, our customers received in aggregate over $1 billion of price improvement on their executions.
Right, but that's not a comparison to your competitors. You know, there are a lot of questions about the accuracy of the best execution reference price. And independent of whether it should be improved, it seems like if I was a customer of you or one of your competitors, what I'd want to see is, you know, I just executed a trade of $2,000 and on average, I got X% better or worse than a reference price. And then over time, and see not only the trade that I just executed, but perhaps a running average over the last month or two that you can compare to the running average of whether you're exceeding some benchmark for trade execution quality that can really be compared with potential competitors. And is that a workable system? Are there difficulties? Is there a reason why industry shouldn't move that way in the name of transparency to customers?
Congressman, this is a very interesting topic to me. I'd love to have the conversation. I don't know if this is the right forum to necessarily ideate and brainstorm on all the solutions, but I just want to say I'd be happy to engage with this in a detailed forum and figure out the right path.
Okay, well, yeah, we do intend to continue to engage with the industry on this subject because it's very easy to make payment for order flow sound really creepy. You know, you're basically selling a list of rubes to the sharks. Okay, on the other hand, you make part of an argument that this can net out positive for consumers, but for it to fully net out positive, they have to be able to make the apples to apples comparison. And so that's, I think really an important issue. And I think that probably your reaction to that, if you found your customers were leaving you because of poor execution quality, you would do what large funds do, which is to split your order flow between multiple order execution firms and then demand of them the best order execution and move your business to whoever does the best for your customers.
Yes, well, Congressman, we already do that. We have 7
Time has expired. Mr. Mooney, you're recognized for 5 minutes.
Thank you, Madam Chairwoman. So let me just start by saying that last Congress, 30 of my Democrat colleagues, 4 of whom on this very committee, co-sponsored a bill that would impose a financial transaction tax on the purchase of securities and certain derivatives. And just recently after the market volatility surrounding GameStop in January, Democrats renewed the call, many Democrats anyway, renewed the call for a financial transaction tax. On just January 28th, Congresswoman Ileana Omar tweeted, "How about this? Financial transaction tax now." Congressman Peter DeFazio is the lead sponsor of the bill. He's already put the bill back in for this session of Congress. It's now House Resolution 328 of 2000. So it's called the Wall Street Tax Act of 2021. I actually have a copy of it from the last session here. It's in again now. And he says, Congressman DeFazio says that a financial transaction tax would, quote, help create a more level playing field for Main Street. So with that background, Mr. Tenev, this question is directed at you. The Robinhood platform has more than 13 million users, and most of them are small dollar retail investors. If the federal government levied a 0.1% transaction tax on the sale of securities, and I know one of my colleagues, French Hill, my good friend, mentioned this earlier, but I want I want to expand upon a little more. how would that 0.1% transaction tax on the sale of securities affect your platform and the retail investors that are your customers?
Thank you, Congressman. And we'd be happy to engage in this discussion much more in the future. A 10 basis point financial transaction tax would eat into the returns of our customers, which, as you pointed out, are largely smaller investors. And in that sense, it would be a cost to the retail investor. Of course, that would have to be weighed against the potential benefits of this tax. And I know it's a more complicated issue than meets the eye at first glance.
Okay, well, thank you for that answer. My next question is actually for Jennifer Schlupp. I know you spent your career specializing in financial regulation. In your expert opinion, would a financial transaction tax directly prevent fraud or market manipulation?
No, I don't think a financial transaction tax would have an effect on fraud or manipulation. I also don't think that it ultimately, financial transaction taxes often fail to raise money, and they distort trading in a way that's not necessarily foreseen initially by the tax. And I'd like to just add in there as well that financial transaction taxes, while they initially might seem like a small imposition on an individual investor, those taxes often hurt individual investors and their long-term retirement goals by affecting the institutions that also do the trading in mutual funds and with retirement money. I don't think a financial transaction tax is a good idea.
And a quick follow-up to that, Mr. Schlupp, what do you think a financial transaction tax would have done anything to prevent the market volatility and disruption we saw just this past January?
No, I don't think it's related here. There's been some discussion that it might have decreased the amount of trading and thus changed the volatility. It's not my opinion that would have had any effect on this particular circumstance.
Thank you. I only have a minute left, so let me just summarize. The financial transaction tax supported by many Democrats would do nothing to prevent market manipulation or fraud, would have not prevented the market disruption in January, and most importantly, would hurt retail investors. Yet Democrats are claiming that the events surrounding GameStop and Robinhood in January make it imperative to implement this financial transaction tax. It just doesn't add up. A financial transaction tax would make it more expensive for small retail investors to trade. And so much for looking out for Main Street. I believe we should be working together to find ways to open up markets to retail investors, not close them. Instead of making trade more expensive with a burdensome tax, let's look for ways to empower retail traders. Thank you, Madam Chair. I yield back.
Thank you very much. Ms. Beatty, you're recognized for 5 minutes. Ms. Beatty?
Thank you, Madam Chairperson, and thank you to the witnesses. My first question is to the CEO, President Ken Griffin. In the first 3 quarters of 2020, your company paid online brokerages like Robinhood $700 million for their order flow. Do you believe that brokers like Robinhood can service the best interest of their users while selling their order flow to companies like yours? And that's yes or no.
Congressman, I believe that Robinhood actually goes further in meeting the best interest of customers by, in fact, routing their order flow to Citadel. We give a better price, a better execution for American retail investors than the alternative of going to exchanges.
So I'm going to take that as a yes, since you said they go further. Then can you tell me, why did your company urge the SEC to ban the payment for order flow models in a filing to the SEC?
Congressman, that is a terrific question. That filing relates to the U.S. options market. It was a filing back, I believe, in 2004. And in the U.S. options market at the time, trades were committed against listed quotes. we were apprehensive about the direction in which the U.S. options market was heading towards the existence of these price improvement auctions, which diminished the incentives to aggressively provide bids and offers in the options market. We felt that legislative or regulatory efforts to encourage tight quoting, to discourage the existence of these auctions, and this was being, in some sense, fueled by a series of payment for order flow programs, was in the best interest of American institutional and retail investors. Now, regretfully, we did not prevail in our reasoning. The rise of price improvement auctions came into, in essence, the day-to-day model for options trading in the United States. And I do believe that this is a setback for our capital markets.
So, because my clock is ticking, let me ask you this. So, are you saying that you no longer believe that the model is anti-competitive and distorts order routing decisions?
I think it's important to distinguish between a market where you must trade on an exchange. In the options market, we must print the trade on an exchange, versus a market where you can trade off exchange, which would be the U.S. equities market. So just to be very clear, because your question is very good, every single options trade must be executed on an exchange. Equity trades do not. And because of that, I can save Robinhood exchange fees and offer a tighter bid-ask spread.
Okay,
than the
clearly
one
we're going to have a further discussion. Let me interrupt you only because my time is clicking, and I want to follow up with a question for Robinhood's CEO. Several of the brokers offer their users order flow for the sale to the firm, like with the previous CEO with Citadel. However, the price that Robinhood gets for the order flow is much higher than any other brokers receives. And I could go on and tell you we've pulled the SEC filings that Robinhood receives 17% per 100 shares stock of traded and 58% to 100 shares, and I could go on. But the question is, why do companies like Citadel pay a premium for their order flows of Robinhood's users?
Thank you, Congresswoman, for that very important question. There's several reasons that may be the case. One important one is that our model and formula for payment for order flow works a little bit differently. We actually receive payment for order flow as a percentage of the bid-ask spread rather than on a per share basis. And we do believe that that's the most optimal way to structure payment for order flow arrangements.
Okay, is it not because companies like Citadel can make more money off of Robinhood users than others? And that's a yes or no, because my clock is going to run out.
No.
I'm sorry, I yield back. My time is up.
Thank you very much. Next, we will have Mr. Vargas. Excuse me, no, Mr. Davidson next, and then Mr. Vargas. Mr. Davidson, you're recognized for 5 minutes.
Thank you, Madam Chairwoman. I thank our witnesses. I appreciate the work you've done today. And I just want to share that in May of 2020, the Depository Trust Clearing Corporation unveiled a working proof of concept called Project Ion. In this project, DTCC said they would examine the potential use of distributed ledger technology in accelerating the clearing and settlement process. Now, since Project Ion was publicly announced, we've received little information pertaining to its progress. As a longtime advocate for this emerging technology, distributed ledger technology and blockchain, today I've sent a letter to the DTCC to request that they provide an update on the status of Project Ion. And I look forward to hearing back from them. Hope to include them in our next hearing. Mr. Griffin, with Project Ion in mind, could you briefly state what would be your biggest concern if DTCC implements same-day clearing and settlement?
Same-day clearing and settlement requires that every bit of the workflow is perfectly synchronized across all parties, and we have no time for recoverability or for error management that you have in an overnight batch process.
Right. So the technology makes that essential in my assessment, and many that is inherent to the architecture for blockchain to move forward with each proof. And so I guess clearly in your business, just to follow up there, the technology exists where, you know, for trading firms that are engaged in high frequency trading, you measure success in the course of the day in what, milliseconds for high frequency trading?
So as you know, we are the largest market maker in the world and the largest in the United States in equities. We put great emphasis on the performance of our systems. That was one of the reasons that on the week of January 24th, we were the only major market center for retail order flow that was responsive every minute of every trading day.
Perfect. So I just wanted to make the point that I think the technology exists, whether you use blockchain or not, and you know, applaud you for having the ability to execute with precision swiftly already. And I don't think it's a barrier. And I'd love to have more dialogue, but unfortunately I have to go to a few others. You know, Mr. Tenev, do you believe that the root cause of January 28th for the problems that you and others experienced were market infrastructure related, particularly related to T2 versus T0?
I believe, thank you, Congressman. I do believe if we had real-time settlement capability and the infrastructure was modernized, we would not have seen similar problems.
Yeah, and thanks for that. I think, you know, one of the related things, and it's related to your mission at Robinhood of more democratic access to capital, is not just the ability for more people in a broader portion of America to become savers and investors. It's also to engage in corporate governance even. So do you believe that if market infrastructure would guarantee, this is really related to, you know, the you know, musical shares where someone could be left with no share when the music stops, multiple claims on a shorted stock. If the market infrastructure would guarantee an investor could retain custody of their shares so that the shares can't be lent to short sellers, there could be a downside. How do you feel that only one claim on the shares would resolve this? And that relates to proxy voting as well, or shareholders voting the shares.
Congressman, I believe that that's an important question. It's one that Robinhood and me personally have engaged with. I do believe that the ability for the same share to be shorted an indefinite number of times is somewhat of a pathology, and that should be fixed. And I think step one of that is modernizing the antiquated settlement infrastructure that everything is built on. We simply don't have the ability to properly track what shares have been shorted and how many times as they're moving through our settlement system currently.
Yeah, thank you for that. And I appreciate that you see the relationship. Hopefully broadly we do, and we provide that nudge the market needs. I want to commend Vice Chancellor Travis Laster of the Delaware Chancellery Court for his letter and paper, The Blockchain Plunger, which explains how this could be done. And I ask unanimous consent to submit that to the record. As my time expires, I want to commend you, Mr. Gill, for just representing a large segment of the industry, in my view, where savvy investors have had an opportunity to engage. And it relates to people with diamond hands that hold. So you might not call yourself a holder, you might use the word diamond hands, but thanks and congratulations for your success.
The gentleman's time has expired, and without objection, your submission is taken. Thank you. Mr.